financial companies, that is NBFCs, eased, while that on certificates of deposits firmed up marginally. The 10-year G-Sec yield softened in August-September on global and domestic cues, including policy pivot in the United States and also in some major economies. And also, these are not the only factors, but the yields in August-September, I'm talking about the 10-year G-Sec yields, they softened somewhat in August and September due to multiple factors, which would include pivot in the monetary policy of the US and some major economies, improved global investor sentiment, benign domestic inflation, and accelerated fiscal consolidation. The term premium, that is 10-year G-Sec yield minus 3-month T-bills yield, has remained stable in the recent few months. Transmission to the credit market has been satisfactory. Moving forward, the Reserve Bank will continue to be nimble and flexible in its liquidity management operations. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner. During the current financial year, that is up to 8th of October, that is till yesterday, the exchange rate of the Indian rupee has remained largely range-bound. The Indian rupee also continued to be the least volatile among peer EME currencies. This was so even during the high volatile episode following the unwinding of the yen carry trade in early August this year. The lower volatility of the Indian rupee reflects India's strong macroeconomic fundamentals and improved external sector outlook. I would now turn to financial stability. The health parameters of banks and NBFCs in India continue to be strong. There has been some recent commentary on the likelihood of stress buildup in a few unsecured loan segments like loans for consumption purposes, microfinance loans, and credit card outstandings. The Reserve Bank is closely monitoring the incoming information and will take measures as may be considered necessary. Banks and NBFCs on their part need to carefully assess their individual exposures in these areas, both in terms of size and quality. Their underwriting standards and post-sanction monitoring have to be robust. Continued attention also needs to be given to potential risks from inoperative deposit accounts, cybersecurity landscape, mule accounts, and a few other factors which we have been stressing and highlighting time and again in the public domain as well as in our interaction with the banks and NBFCs. Now, overall, I would again like to stress that our banking and the NBFC sector, that is the financial sector, remains healthy, resilient, and stable. NBFCs in particular have registered an impressive growth over the last few years. This has resulted in more credit flow to remote and underserved segments, bolstering financial inclusion. While the overall NBFC sector remains healthy, let me re-emphasize, while the overall NBFC sector remains healthy, I have a few messages to certain outliers. First, it is observed that some NBFCs are aggressively pursuing growth without building up sustainable business practices and risk management frameworks, which should be commensurate with the scale and complexity of their portfolio. An imprudent growth at any cost approach would be counterproductive for their own health. Second, driven by significant accretion to their capital from both domestic and overseas sources, and sometimes under pressure from their investors, some NBFCs, including microfinance institutions and housing finance companies, are chasing excessive returns on their equity. While such pursuits are in the domain of the boards and managements of NBFCs, concerns arise when interest rates charged by them become usurious and get combined with unreasonably high processing fees and frivolous penalties. These practices are sometimes further accentuated by what appears to be a push effect as business targets drive retail credit growth rather than its actual demand. I am not generalizing it for the whole NBFC sector. There are certain NBFCs where it is happening bilaterally. We are engaged with them, but I think this is a message which it's important not only for these outliers to keep in mind, but I think this should act as a guidance for the entire sector. Now, the consequent high cost, I was talking about the push effect, that is business targets driving retail growth rather than its actual demand. In that context, I would like to say that the consequent high cost and high indebtedness could pose financial stability risks if not addressed by these NBFCs in time. Third, NBFCs may review their prevailing compensation practices, variable pay, and incentive structures, some of which appear to be purely target-driven in certain NBFCs. Such practices may result in adverse work culture and poor customer service. To sum up, it is important that NBFCs, including MFIs and housing finance companies, follow sustainable business goals, a compliance-first culture, a strong risk management framework, a strict adherence to fair practices code, and a sincere approach to customer grievances. The Reserve Bank is closely monitoring these areas and will not hesitate to take appropriate action if necessary. Self-correction by NBFCs would, however, be the desired option. Coming to external sector, India's current account deficit, that is CAD, widened to 1.1% of GDP in the first quarter of this financial year, that is 24-25, and this was on account of higher trade deficit. Buoyancy in services exports and strong remittance receipts are expected to keep the current account deficit within the sustainable level. On the external financing side, foreign portfolio investment, that is FPI flows, have seen a turnaround from the net outflows of $4.2 billion in April and May this year. They have turned from net outflows. In April and May, we had net outflow of $4.2 billion. Now they have now turned to net inflows of $19.2 billion during June to October, and this is the figure till 7th of October. Foreign direct investment, that is FDI flows, remain strong in 24-25 as both gross and net FDI flows have improved in April and July. While external commercial borrowings moderated, non-resident deposits recorded higher net inflows compared to last year. India's foreign exchange reserves have already crossed a new milestone of $700 billion. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. And when I say key external sector vulnerabilities continue to improve, I have backed it up by the data in the footnote of the statement. On the whole, we remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures. The first relates to responsible lending conduct, levy of foreclosure charges, and or prepayment penalties on loans. The Reserve Bank has taken several measures over the years to safeguard consumer interest. As part of these measures, banks and NBFCs are not permitted to levy foreclosure charges or prepayment penalties on any floating rate term loan sanctioned to individual borrowers for non-business purposes. That is, for purposes other than business. It is now proposed to broaden the scope of these guidelines to include loans to micro and small enterprises, that is MSEs. A draft circular in this regard shall be issued for public consultation. The second announcement relates to discussion paper on capital raising avenues for primary urban cooperative banks, that is for UCBs. The Reserve Bank has undertaken several initiatives in recent years to strengthen the UCB sector. Such initiatives include issuance of regulatory guidelines in 2022 for issue and regulation of share capital and securities by the urban cooperative banks. To provide more flexibility and avenues to the UCBs, that is urban cooperative banks, to raise capital, a discussion paper on capital raising avenues for UCBs will be issued for feedback and suggestions from stakeholders. The third announcement relates to creation of Reserve Bank Climate Risk Information System. Climate change is emerging as a significant risk to financial system world over. This makes it necessary for regulated entities to undertake robust climate risk assessment, which is sometimes hindered by gaps in high-quality climate-related data. To bridge these data gaps, the Reserve Bank proposes to create a data repository, namely the Reserve Bank Climate Risk Information System, or in short RBCRIS, Reserve Bank Climate Risk Information System, that is RBCRIS. The next announcement relates to UPI, where we are enhancing certain limits for the various transactions. UPI has transformed India's financial landscape by making digital payments accessible and inclusive through continuous innovation and adaptation. To further encourage wider adoption of UPI and make it more inclusive, it has been decided first to enhance the per transaction limit. To enhance the per transaction limit in UPI 123 Pay from rupees 5,000 to rupees 10,000. And second, it has also been decided to increase the UPI Lite wallet limit from rupees 2,000 to rupees 5,000 and per transaction limit from rupees 500 to rupees 100. The final announcement relates to introduction of beneficiary account name lookup facility. Let me explain what it means. At present, UPI and Immediate Payment Service, that is IMPS, provide a facility for the remitter of funds to verify the name of the receiver of the funds, that is the beneficiary, before executing a payment transaction. It is now proposed to introduce such a facility for RTGS as well as the NEFT systems. This facility will enable the remitter to verify the name of the account holder before effecting funds transfer to him or her through RTGS or NEFT. This facility will also have the effect of reducing the possibility of wrong credits and frauds. Let me now conclude. Today, the Indian economy presents a picture of stability and strength. The balance between inflation and growth is well poised. India's growth story remains intact. Inflation is on a declining path, although we still have a distance to cover. The external sector demonstrates the strength of the economy. Forex reserves are scaling new peaks. Fiscal consolidation is underway. The financial sector remains sound and resilient. Global investor optimism in India's prospects is perhaps at its highest ever. We are, however, not complacent. I repeat, we are not complacent, especially amidst the rapidly evolving global conditions. The monetary policy action today reflects the MPC's assessment that at the current juncture, it would be appropriate to have greater flexibility and optionality to act in sync with the evolving conditions and the outlook. We stand unambiguously committed to ensure durable alignment of inflation with the target while supporting growth. In the prevailing macroeconomic conditions and the outlook Mahatma Gandhi's words remain highly relevant, and I quote, "When the method is good, success is bound to come in the end." Thank you. Namaskar.
All right, so I think it ticked all the boxes. The biggest takeaway, because the fact that there's going to be no rate change was expected, but the biggest takeaway is truly the change of stance from withdrawal of accommodation to neutral. It's a softening of stance, and it's paving the way for rate cuts which could follow in the next policy onwards. Very benign statements on inflation as well, and especially interesting is when the governor talks about inflation as a horse that has been brought to the stable, but they have to make sure it doesn't bolt anymore. Moderation in inflation could reverse in September, so that is perhaps explaining why no rate cuts right now. Core inflation seems to have bottomed out, and important also that they expect government expenditure to now pick up pace. That has been slow so far. Relatively, private expenditure and consumption has been pushing the economy. The economic outlook continues to remain positive. Jayesh Mehta, DSP Finance, with us this morning. Katrina L, Moody Analytics, joining us, as is Jaideep Iyer of RBI Bank. Welcome to all of you, and great to have you on the show. Jayesh, let me start with you with your take. Do you think that this was exactly what was expected, and we're now setting the stage for rate cuts to follow?
So this is, as far as stance is concerned, they already started infusing liquidity, and with the surplus liquidity, they had to change the stance. In terms of rate cut, they would like to see the actual figures. So that's where, right now, because of the base effect, the projection of inflation has not been changed at all. Even the growth, GDP growth projection has not been changed at all. So by December, I think both of that could be lower, and that's where we have the scope for change in rate. Because as of right now, though inflation is under control and real rates are higher, but GDP is not the GDP is not suffering, the growth is not suffering, and that's why you could keep higher real rates of 2%. But that has to change, and maybe hopefully they will do that in December.
Right, we also have with us Katrina of Moody's Analytics and Jaideep Iyer. Jaideep, hi, it's Amina. I'll start with you. Most people believed that there wouldn't be much in terms of a rate cut or a change in stance. Interestingly, I do understand that the liquidity in the banking sector last week indicated that there could be a change of stance. From where we stand right now, what have you made of the policy, and what do you think is keeping the RBI away from moving on rates at this stage? Because if inflation is controlled more or less, then why wait?
No, so I think as a banker, first of all, I am actually quite happy that we saw a change in stance prior to the actual rate cuts, because this is, by the way, the first, let's say, change in rate cycle that is expected when the banking sector has a significant amount of loans which are linked to external benchmarks and mostly repo. So from a purely banking standpoint, we would prefer liquidity to be easy for a while, where bulk rates come down, retail deposit rates start inching down before we have a rate cut cycle. So to that extent, I think it is good. I think the answer to your question on why rates, by the governor being cautious on rates, I think Jayesh mentioned that I think we still seem to have a very, very robust growth environment in terms of GDP growth. Actually has been, I think, upped in terms of estimates for the next 12 months. And we have a nice confluence of fairly stable macroeconomic policy, macroeconomic factors, current account deficit largely in control, fiscal deficit again path to consolidation. So I think in a way, India is standing out in that sense, and I think given the let's say the geopolitical situation, I guess it is okay to be a little cautious on the cutting of rates front.
Okay, Katrina, good morning to you, and thanks for joining in. What would you have expected from India's central bank, considering that, save for exceptions like Brazil, Japan, etc., most central banks are aggressively cutting? Would you have expected the Reserve Bank to do an encore, or is this a good heady mix? move around with liquidity, set the stage for a cut, but cut only when India needs to, because India has got that luxury to be able to cut when it wants to, not necessarily follow the Fed.
Yeah, I think that's exactly right. So I think what we saw from the RBI today was really broadly as expected. I think it was a really good move in the extremely volatile geopolitical backdrop that we've got at the moment to provide as much forward guidance as they possibly can, right? And so the fact that they shifted to neutral, as they were widely expected to do, really does then set up expectations appropriately for a cut to come, most likely in December. And I think one thing that I was a little bit surprised about was, I guess, the RBI's quite optimistic view on inflation. They've said that, core inflation has bottomed, headline inflation is hovering just below that 4% midpoint target, which is a positive thing. But I think we also need to keep in mind there are those upside risks to food inflation, given weather impacts, but also, and perhaps even more importantly, given what we've seen in the past week or so in terms of that escalation of violence in the Middle East and what that's done to oil prices, we need to really remember that India's inflation, near-term environment is highly vulnerable to changes in global oil prices. And so I think keeping that stance in terms of rates being on a hold does kind of give them a bit more breathing space to keep inflation expectations more anchored, given the upside risk to oil prices at this stage.
To be fair, Governor did lay out exactly 3 risks, which was weather patterns, geopolitical, developments, and commodity prices that have gone on. But Katrina, I want to come to you on a slightly broader issue. So, with inflation relatively in check, perhaps Indian central bank doesn't need to cut prices right now. But if you look at it in context of what China has been doing, and of course the rate cut which we saw in the United States, do you think that December now is a given?
I don't think we can really say with any sort of certainty that December is a given. I think there's still quite a lot of life to be lived between now and December. And as the past couple of years have really crystallized for us, best laid plans can fall by the wayside in an instant. But I think what we are seeing is that the RBI has really set the stage, I think, for that December cut. But I think, things can change. And I think we need to be cognizant of that. I mean, it was only with the Fed's 50 basis point cut that came as quite a surprise to markets, because it was that outsized cut. So I think the good news is that the RBI does have that space to, keep rates on hold at this more restrictive territory if they need to, given that the domestic macroeconomic conditions are actually doing quite well.
Yeah, you want to come in on this one? It's not just crude. We've also seen a massive surge on coal prices. So both those factors usually disturb the macros of a country like ours. Of course, the governor's talked about how core inflation has been reined in. Do you feel like there's a pretty evident, obvious upside risk to our inflation number, given the way crude has been moving recently? Jayesh, that's for you.
So I think, the way I look at this is we as market player, we look at both positive and negative on a expectation basis. Generally, central bank tends to actually see the data. As of right now, they haven't changed their forecast either for growth or inflation, which market would have, on both the count, market is currently looking at a slightly lower than the projection. And maybe hopefully in December, they will change it. So they would, when it comes to rate cut, they would be more going by actual data, whereas it is a precautionary rate hike or something, they may look at the forward-looking data. So that's the first premises, and that's where the disconnect between us and the market expectation and the central bank. In terms of risk, Yes, these three risks are always there. Geopolitical, of course, is there, but for us, geopolitical actually comes to the crude price, right? And as of right now, we have seen enough tensions, but in spite of all that, it's still hovering in the 80s, right? And we haven't changed the retail fuel price and other stuff, so we have enough buffer. Unless it goes to maybe 120, 110, 105, that's a different story altogether. So even if you have a projection as of today, when things crude price goes to 120, it's a very, very different scenario. So it's not predictable in that situation. And that can happen any day. It can happen the next day after a cut also. So that can happen any day, anytime in the world. So as of right now, I would say they would. It's more of wait and watch. Maybe see the September, October, November data, and then maybe they will change the forecast either for inflation or for GDP growth, and that's how they will justify the cut. And I'm quite confident that will happen in December.
Fair point. By the way, just marking that banks are again recouping some of the lost ground, but NBFCs have stayed stable, and the financials, I mean, despite the cautionary warning for some of the NBFCs which are wanting to grow fast from the Reserve Bank governor, I think Nifty Finance by and large seems to be doing okay for itself. To be fair, Jaideep, I mentioned this last time that he would rather have liquidity conditions ease first and then a cut later. So that's what happened. He should be happy, as he mentioned. Getting another banker's view as well before I go back to Jaideep. Venkatraman Venkateswaran, who is the CFO of Federal Bank, also joining in. Mr. Venkatraman, are you happy with the moves done? No rate cuts, but stance change, setting the stage for a cut if need be, and liquidity measures, a lot of talk around that.
Yeah, hi, good morning. I think the announcement was in line with what was expected by us, with the no change in, no rate cut, but change in policy stance. So that kind of, gels well with what was expected. So there's no surprise per se on that. And in my view, what is important to watch, which the governor emphasized more than once, unambiguous focus. The word unambiguous was used at least 3-4 times in his speech. So the focus on inflation is pretty much there. And the food inflation obviously is something which they are watching very carefully, while the CPI is expected to settle at around 4.5% is what was mentioned. But what is important is how the food inflation plays out, and that will determine the next course of action. And of course, there are a lot of other factors which do impact the food inflation.
Mr. Venkatraman, just, in terms of the messaging which is coming out with no changes to the GDP outlook or the inflation outlook, do you expect that to be moved in the next policy? Because now you've had the change in stance, but do you need those bricks to also fall in place? What do you think now will give comfort? Because if inflation is largely on target, your repo is still at 6.5, that's an equation that needs to change sooner than later?
I think between now and December, of course, we can't predict much on the geopolitical and the conflict in West Asia. If you've seen off late, the West Asia conflict has taken more priority over what was happening in Russia, Ukraine. And a few days back, of course, the ministry had mentioned that the sources for crude oil import for us is beyond West Asia. But having said that, the impact of what happens in that part of the world will determine the overall crude oil price. In the previous meetings, I think it was mentioned that anything between up to $80 per barrel is something which is baked in. Not a surprise on an average, obviously. But if it starts going up consistently beyond that, let's say in the next 2 months, then there is likely to be, it's all driven by data. So I'm sure the RBI will look at what are the recent data which they get, the festive season, how is the manufacturing growth picking up, the private capex, which have all started, how will determine the next course of action. But having said that, the change in stance is something which gives us comfort that it has been thought through. They are not going to kind of go back on that. So what needs to be seen is how does the Kharif, the sowing has been quite encouraging. We don't expect too much of weather vagaries in the next few months. So the monsoon is behind us, good monsoons.
Okay, Jaideep, come to you. You mentioned this at the last time, as I said, that this is what you wanted. It's come out this way. He's mentioned also that the conditions had turned into deficit, proactively conducted two-way ops, will continue to do this. What would you now watch out for? Because the commentary seemed dovish, the stance change has happened. What is next in store? Let's say you predicted this policy right. Now I'm asking you to predict the next policy, Jaideep.
Yeah, so Neeraj, I think what banks would look for is sustainable, durable liquidity. So we don't want deficits going back again, and random reduction in liquidity. So we will expect the RBI to kind of maintain positive liquidity for elongated periods, so that there is confidence that this is going to be the norm rather than exception. And once that happens, we will start seeing some reduction in liability cost for banks. And therefore, banks will then be reasonably prepared for looking at when the rate cut happens, then obviously the asset side also starts getting cut. From an expectation standpoint, Neeraj, I think my guess is that we are largely likely to be set for a cut in December, except for the lot of discussions around crude oil prices and the West Asia conflict. I think that is a joker in the pack, which is hard to kind of predict. But other than that, I think if you look at domestic factors, I think I would bet on the fact that there will be a cut in December.
Katrina, you want to come in on the currency? The rupee has been a well-managed currency from the time we can remember. Of course, we've seen a little bit of a decline, largely on back of the Japanese yen and the Chinese yuan activity against the dollar. With rates being left unchanged, what is your word on the dollar-rupee pair? And more importantly, there was some parts of the market that talked about how the rupee could become a carry trade currency if the rate differential remains elevated. Do you see that coming?
So, I think one of the contributing factors that we haven't really covered yet in this discussion about why the RBI has kind of held rates that little bit longer is to provide the rupee that little bit more support. We have seen, a bit more dollar weakness of late following this well-anticipated cut from the Fed. And so that's kind of been some support to the rupee. But at the same time, the rupee is still relatively weak by historical standards. And I think we need to remember that because it's relatively weak, it's also adding a little bit to imported inflation as well. So it's one thing that, food prices are tracking the way they are, and there is some upside risk to that. But at the same time, that ongoing weakness in the rupee should be considered. And I think if the RBI did actually come out and cut today, we would see renewed weakness in that currency because it wasn't such an anticipated move. So I think they've done some deliberate kind of, currency management with their communication today, which is important. And I think that's something that will kind of remain a factor right through the end of this year, particularly given this, more volatile geopolitical backdrop that we're dealing with. We have seen the strong dollar come off a little bit, but if we do see more heightened risk aversion in global financial markets, then we will see that dollar strength come on again. And so that's something to kind of just keep in mind through this global easing cycle that we're in the midst of, and that the RBI is kind of managing through with this still relatively weak rupee, but certainly I agree with you that it has been well managed through this earlier hiking cycle.
It is the invisible hand that we frequently talk about. Jayesh, you want to come in on your view on the dollar-rupee pair? Of course, we've seen a lot happen on global currency pairs. The dollar has strengthened. You've had the Japanese yuan, the Japanese yen, the Chinese yuan go through very big swings. Now, I know the rupee is a well-managed currency and always has been. Our reserves stand at record highs. Apart from China and Switzerland, we're the only countries sitting on such big coffers. What is your view on the dollar-rupee pair? And do you feel like we do run a risk of the rupee becoming a carry trade currency until the rate differential between the dollar and rupee remains elevated?
think, from a carry trade perspective, yeah, people do put a little bit of it, but not really much, because we are not still fully convertible. It's only through FPI route on the situation. And also, with the range being so narrow, right, it is very difficult to see the breakout. So when the breakout happens, especially with the geopoliticals and all that, right? The breakout can happen at 84, but it will not last long. Of course, fundamentally, we all look at it much going. So people do put in some carry trade, but it's like, the same thing happened at 83, same thing happened at 83.50. We are at 84. Though my personal view, I'm very bullish on rupee, but we have to see next couple of months how it goes. And even when the appreciation opportunity comes, the central bank is not let it appreciate also, right? We had the last 2, 3 months enough opportunity for rupee to appreciate. So that's when we have to see the sustainable flow. Hopefully next quarter, when we see FPI equity flows, you guys know that better. Then maybe we'll see some rupee appreciation, and that's where we will see the change of base in the appreciation side to 83.50 and then 83 and then whatever it is.
Okay, so all in all, I think consensus, fair to say, on the panel of speakers today is that you could see something in December, largely. I don't know if Christina is very convinced, but mostly I think the consensus seems to be that this policy has paved the way. The change in stance to neutral from withdrawal of accommodation has paved the way for a cut in December. But a lot of buts and ifs out there, because we don't know what's happening geopolitically. We have commodity prices which are very, very volatile, and weather risks. I think that was one strange or maybe unusual kind of a point put in, that what are the weather risks from here on, but more to discuss on that. Thank you so much to all of you for joining us, and I don't know if there are any views on that over here. Why is weather a risk now? Because your key season is behind you. Governor says that monsoon was good, agricultural output is looking good. I'm wondering what is the key weather risk between now and December that he would talk about? Geopolitical weather, definitely.
Yeah, I don't know. I mean, the Florida ports are shutting down because of hurricane season there. Yeah. Now, I have no idea if global weather moves impact shipping and so on and so forth, and therefore commodity costs and shipping costs.
But he's talked about weather conditions for the last 5 policies. So this is not
so pertinent during the monsoon season in India.
I can answer pre-monsoon. But okay. Anyway, maybe Pallavi has gone through all the nuance. Pallavi, we've talked about the key takeaways, but what is the nuance we're missing? I think this is definitely fair to say a more dovish policy.
Absolutely, Tamanna. Actually, maybe possibly a policy that's somewhere in between, because the MPC changing stance does come as a big move and a possible step towards a rate cut. But at the same time, the governor, like his previous policies, continues to emphasize on inflation. On multiple occasions during his speech, he did speak about the upside risks to inflation. In fact, like we can see from the inflation projections, while the RBI has retained their forecast for the full year, we did see some tweaking around with the quarter-wise projections, with the Q3 inflation figure likely to come in at 4.8%. And even apart from that, just the continued emphasis on the multiple risks from possibly the geopolitical front, from local developments, which could mean yeah, so basically the upside risks to inflation was something that he's continued to focus on. Also, apart from that, something that stood out was, in terms of GDP growth, a lot of us and a lot of economists too were actually expecting some cut in the GDP growth projection, given what we saw in terms of the GDP growth figure for Q1, and the fact that we have seen a consistent easing across several high-frequency indicators, be it the index of core industries, the PMI data that's just come in, what we are seeing in terms of merchandise trade as well, with sort of a visible hit on exports. GST collections, despite that, GDP growth has been retained at 7.2% for the full year, though there again we did see some revisions or some tweaks to the quarter-wise projections.
I just want to ask about the warning for NBFCs and HFCs. Among other things, he also talks about compensation structure. So I know not about policy, but so much which has been happening recently in terms of work-related stress, complaints about recovery, etc. Is that the backdrop in which these comments were made?
Absolutely, that is possible. That is a conversation that's taking place in the broader sort of industry as well. And the RBI too clearly seems to be taking note, picking up on some of these developments. And it was a little bit of a surprise. The RBI governor did say that they are closely monitoring a whole combination of these developments, and they will not hesitate to take action as and when required.
Okay. Pallavi, good summation, guys. Just before we wrap up, a personal question. Did anybody pick up and Pallavi, you can chime in as well. Did anybody pick up if he mentioned about the NEFT or RTGS rates?
Nothing at all, actually.
Which is 99 rupees currently. Did he mention it will come low?
He said more measures of payment which will allow verification, but some of them are charged. They're all charged right now.
But no mention on the charges, right?
No mention on the charges that at least I heard. It should be for free. To increase that kind of trust in online payments. But anyway, that's all the time we have on this special show. Stay tuned. A lot more coming up on the other side, including our continuing analysis of the monetary policy. Stay tuned.
NDTV World Summit 2024, October 21st and 22nd, only on NDTV Network. NDTV World Summit 2024, October 21st and 22nd, only on NDTV Network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
You have a missed call. Let's be real, guys. There are many financial experts out there. Which stocks to target, what's good for long term, when to buy, when to sell. How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
NDTV World Summit 2024, October 21st and 22nd, only on NDTV Network.
and the whole day passes like a blur. The news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 3...
Hello and welcome. You're tuned into NDTV Profit. I'm Harsh Saita. We continue our special coverage of the MPC and everything that's come through on the back of that. First off, policy repo remaining unchanged at 6.5%, but a stance change which likely paves the way for a change in the repo as well, maybe a meeting or two away. You're also seeing moderation in inflation starting to likely reverse in September on the back of a favorable base, or rather unfavorable base, if I can term it that way. Core inflation seems to have bottomed out. According to the governor, government expenditure expected to pick up pace. GDP growth outlook for FY25 remains unchanged, and an unchanged inflation projection as well at 4.5%. Risks to inflation will be weather, geopolitical risks, as well as commodity prices. Those are just some of the many takeaways from the MPC's latest meeting. Now, one other piece also is the RBI is closely monitoring potential stress in the unsecured lending space and has also cautioned NBFCs to avoid usurious practices with regard to lending. Now, that's another couple of pieces that we will discuss. And, we've got Rajiv Anand, who's the Deputy MD at Axis Bank, to talk to us about all of these and maybe give us better perspective. Rajiv, how would you look at, first off, good morning. How would you look at the policy and how would you look at this change in stance? How quickly do you think it's going to pave way for rate cuts? Okay, I believe we have him on a patchy line, but yeah, I mean, so some of these factors playing out. Let's quickly have a look at how markets are responding. Let's pull up the Nifty 50, see how that's really playing out, and the Nifty Bank especially. There you go, clearly positive, 0.8% higher. So markets seem to be cheering this change in stance and possible paving way for rate cuts as well. So that's one interesting piece. Let's look at some of the top gainers in terms of the Nifty 50. Infosys, ICICI Bank contributing well to the Nifty 50. Let's pull up some names as well. Something like a Bajaj Finance likely to benefit from a rate cut if at all that were to come through. Of course, didn't come through today, but that will be in focus. There you go. Trading well in the green, 3% higher on Bajaj Finance in trade today. 7,400 plus is the intraday high that one has clocked. Let's pull up the sectoral heat map, see which sectors seem to be doing well. Realty Pack will definitely also be the other one in focus, and we will speak with managements to get context on that. But there you go, the Nifty Realty up 2+%. PSU Banks also doing fairly well, nearly 2% higher. The Nifty Pharma Index, of course, doing well, 1.5%, but the Nifty Bank will be more in focus, 1% or so higher as well. What's not doing so well? Well, domestic, 0.7% lower on the Nifty FMCG. Do we have Mr. Anand again? Just quickly checking in. Okay, perfect. Rajiv, I hope you can hear me.
I can hear you.
Hi. So just your quick take with regard to the policy. Of course, stance change, no rate change yet. How quickly do we see a rate change, and your quick views?
I think broadly on expected lines, I think there is so much of uncertainty across the globe at this point in time. Yes, we saw a big rate cut in the US. We're seeing geopolitics, play out quite aggressively, and I think RBI has been pragmatic at this point in time. It's built the bridge to a rate cut, but it's left the door open. May or may not happen in December, but will probably happen sometime between December and March. Is what we believe. But I think the bigger issue, for banks is, you have a 10-year at 675, but on the margin, banks are raising money, from non-retail term deposits at for 1 year at somewhere between 7.75 and 8%. And we would certainly like to see with this change in stance, the short end of the curve begin to come down a little bit as well, that will certainly help banks in the short to medium term.
Liquidity currently definitely in focus. It's something that both the street as well as the governor seems to be focused on, maybe indirectly, not as much directly. How do you view liquidity and how do you see it easing? Just give us your view with regard to how quickly can it start to ease, and therefore how quickly can it start to impact the banking sector as well as other financials?
I think the RBI has certainly moved in terms of its stance on liquidity. It had kept liquidity quite tight, but over the last couple of months, we've seen liquidity ease off, meaning that overnight rates have fallen just a little bit. But I don't think the market has the confidence yet, which is really why the longer end, the 3 months, 6 months, and 1 year rates, have not come down. It is because of sort of various reasons as well. One of the reasons being that government spending has been a bit anemic at this point in time. We do believe that that should start to catch up in the second half of the year, and so therefore my expectation or my hope is that in the second half of the year we will see short-end rates coming down.
Right. So maybe second half of the current financial year. I want to also touch upon what your view is with regard to rates again, because what seems to be the case is that if at all the RBI does not cut in December, you suggested rate cuts between December and March likely to start, at least for the RBI. It seems if the RBI doesn't cut in December, the interest rate differential between the India and US will be quite high. Would that at all be on the governor's mind in your view?
I think we've got to look at the yield curve in two separate pieces. We just spoke about everything up to 1 year. We are very bullish on, let's say, for example, everything beyond 5 years. The demand supply situation has significantly changed, meaning that the fiscal situation has significantly improved, meaning that the government will issue the same or slightly lower as we go forward. More buyers have come into the market thanks to the JP Morgan index, thanks to the FTSE inclusion, and sooner than later the Bloomberg inclusion as well. And so therefore you're going to see a situation where supply is going to be constrained from the government of India, but the demand is only going to increase. And so therefore we are quite bullish as far as long bond rates are concerned, and which in general is good for the economy, good for corporates, good for the government.
Right, and clear impact of the liquidity will be on deposit rates, especially for banks like you. Now, I'm not mentioning Axis Bank in particular, but just give us a lens into the entire industry. Do you believe deposit rates will cool off given the kind of situation we are just coming out of? Likely, will deposit rates cool off maybe 3 to 6 months from now? Is that expected at all, or will margins start to compress for the industry as a whole?
2 points there. I think the expectation is that deposit rates have certainly peaked. I don't see deposit rates going up from here. But will they cool from here? I think that's a question that will get answered over a period of time. I think if deposit rates don't cool off, I think you're going to see a further slowing of credit. Ultimately, banks are a marginal cost business. If the cost of funds goes up, it is inevitable, perhaps with a lead and lag, that the higher cost of funds will get passed on the credit side.
And you of course, but there are other large lenders as well who have faced some bit of asset quality. Can I say the stress has started to show, if at all, just a little bit. The governor has warned of lending practices. He's spoken of NBFC's lending, and he's spoken about how they have to be more cautious with regard to their lending, even though growth is extremely strong. Are you seeing some of those trends play out, and is that competition high even now, or are you seeing a little bit of an ebb with regard to the way lending is playing out in those pockets where there is asset quality concern, something like an MFI, something like an MSME?
We are certainly. I mean, if you look at, I mean, we will still have to wait for the current quarter numbers to get to announce for all the banks and NBFCs. But if you saw the last quarter, we did see in the sectors that you mentioned, we did see across the sector a slight increase in terms of credit costs in MFI and unsecured. And I think that's exactly the point that the governor spoke about today, that banks should certainly be cautious within this space in terms of kind of lending behaviors that they are exhibiting, and we completely agree with that. You have seen that lending in this sector has come down for both NBFCs as well as banks. We will have to wait and watch in terms of how credit behavior is playing out before we are able to assess what the next course of action should be. But I think the RBI and the governor's warning today is well received.
Right. And Rajiv, if I can pick your brain with regard to both growth, overall GDP perspective, as well as loan growth in the industry as a whole. What's the sense like? Do you expect on this higher base loan growth to start to cool off? And at the same time, can we expect GDP growth to hold given that the repo is still at 6.5?
I think in the context of where we saw GDP growth in the first quarter, the fact that RBI has held its GDP growth numbers, I think is certainly a positive surprise. As far as credit growth itself is concerned, I think we've already seen a cool off, and we've also seen the gap between credit growth and deposit growth narrow. I think we'll finish the year, somewhere in this vicinity of 13 to 14%, broadly, where we are at this point in time.
LDR unlikely to shrink, right, Rajiv? Point being that till the end of the year.
That's correct. That's correct.
Okay, point taken. Thank you so much, Rajiv. It's been a good perspective. It's been good chatting.
Thank you so much.
Have a great day. Okay, let me also welcome on board Shweta Daptardar, who's the Vice President at who tracks BFSI rather at Elara Securities, joining in on the phone line. Shweta, of course, one is the key concern here, especially when it comes to the NBFC sector, is the fact that the RBI and the governor has cautioned the sector from an asset quality perspective and lending practices perspective. What, in your view, is he inferring when he talks about these lending practices?
Yes, good morning. So as you rightly pointed out, Governor has clearly highlighted some key risk in the NBFC space and largely alluding to the fact that few NBFCs, especially in the MFI and housing finance space, have been chasing return on equity by charging usurious interest rates. There have been chasing of business targets and compromising on credit quality, which has been posing balance sheet risk. And last but not the least, Governor also reiterated the concerns over increased borrower indebtedness. So against this backdrop, in fact, we have been highlighting this for quite good number of times at several occasions that growth expansion will be calibrated henceforth for the entire space. And this is also largely coming from the fact that not only because there is increased supervision by the regulatory side and regulatory forbearance coming into picture, but also because of the way the granularity has increased on the funding side. So while NBFCs have been nimble in terms of liability management, we have seen a higher funding cost definitely bothering the net interest margins and therefore earnings expectations for NBFCs. So clearly going forward, while in fact for Q2 FY25, we are already seeing initial signs of credit cost spike. So while provision buffers will sort of catch up, growth will also look calibrated. So we'll definitely see some pressure coming in for NBFCs in near future. And alongside that, going by the strong words of the governor, you might also expect certain change or review of guidelines or norms, especially pertaining to risk pricing or credit risk management in near future.
Shweta, NBFC is a difficult pocket at the moment because likely going to be the first key beneficiary of an interest rate cut if that were to happen, say December. And what you are suggesting is that there is plenty to be cautionary about in this segment as well. Just talk us through some names. Where would you be cautious? If not names, maybe segments, if you are not able to give us names. But if possible, give us names. Which my belief is that the ones which are going to do well on the asset quality side will likely do very well and will likely outperform. So just trying to get your view as well as some names for viewer perspective.
So yes, we are sort of staring at lower interest rate regime sooner or later.
Right.
But absolutely, we have to be also cognizant of the fact that the quantum of rate cut is essential than just the rate cut. But even then, NBFCs are greater beneficiaries of lower interest rate regime. And if I were to highlight asset domains which will benefit directly in lower interest rate regime, would be consumer finance loans, will be vehicle loans and gold loans. These are the kind of asset classes which will benefit. But as you rightly pointed out, the current environment is definitely slightly difficult, making it difficult for NBFCs in turn to expect and have a sizable and clear earnings growth potential, at least in the near term. So going forward, what we are seeing in light of lower interest rate regime is, while your margins will continue to hold, the pressure will arise more from asset quality risk. And certain sectors, as we have already seen for past couple of quarters, MFI, unsecured loans, even credit cards, have seen certain customer cohort showing over-leveraged kind of risk.
Right.
So from that perspective, there is definitely a difficult environment there out for NBFCs to grow on the earnings front.
Okay. Point taken. Thank you so much, Shweta. It's great having perspective. Of course, it's a big day. Let me bring on board a big guest as well, Ashwini Tiwari, who's the Deputy Managing Director at Managing Director at SBI. Apologies, sir. Welcome. Good morning. It's always a pleasure speaking with you.
Good morning. Good morning.
So just first give us perspective. Do you think enough is done on the liquidity front? Because that's one of the key problems currently in the financial sector.
So our house view wasn't that the stance would be changed. We were expecting a continuation of the existing stance. But now that it has been done, we will wait to see as the governor himself said that should all the conditions should align and the risks in geopolitical terms and also commodity prices, etc., should not materialize. So therefore, we continue to hold the view that January, February would be the time when probably a rate cut might happen. In terms of liquidity, as you asked, I think the liquidity overall is good, and the RBI always says that the system liquidity is satisfactory. What we are seeing is that though there is a tempering of the credit growth as also the deposit growth, leading to the gap between them coming down to almost 150 basis points, which is the lowest since May 2022. So therefore, this has come down and therefore reduced some pressure on the lending and deposits. But still the gap continues. So therefore, as long as credit growth is higher than the deposit growth, we will continue to see some pressure in terms of liquidity and therefore margins.
Right. So you spoke about credit growth getting tempered. Is that visible on the ground, and do you believe it's going to also impact GDP growth? Because currently, RBI's estimates of GDP remain unchanged. Do you believe RBI can do the 7.5%? Or rather, India can do the 7.5% which RBI expects? Sorry.
So this credit growth slowing, which I talked about, is a very recent phenomena. It's the last month or two numbers.
Right.
Whether this will continue in the same manner, one doesn't know, because what we are seeing that even as unsecured loans, etc., the growth has come down in line with what the RBI wanted. But on the other side, the construction growth, the real estate has picked up very strongly, and infrastructure continues to go strong because after Q1, where because of elections, the project draws, etc., were not happening on the government side, it has again picked up. So our view is that overall the credit growth will continue to be in the range of 13 to 15%. It is lower than the earlier 15 to 17, but one has to remember that the base is also higher. So on a higher base, this number in absolute terms, it's still continuing to be higher. So if the credit growth comes down secularly, then surely it will impact the GDP. But I don't think we hold that view as yet.
Got it. So it may temper, but not as much. Talk to us about deposit rates in the system. Of course, they likely have peaked. What's your view? If at all a repo rate could come, maybe say in December or say in February following that, do you believe that rates will come down? Will deposit rates at all get impacted, or will deposit rates remain elevated?
So deposit rates come down after the rate cuts happen, but always with a lag, because those who are logged into fixed deposits will surely wait for maturity to happen before they are repriced. So in that sense, there will be a 2 to 3 quarter lag before deposit rates start to show downward trend. But as I pointed out, the credit growth continues to outpace the deposit growth. And as long as that continues, there'll be pressure on deposit rates. And so far, we haven't seen deposit rates coming down in any manner at all. And in fact, depending on the requirements, certain buckets, banks continue to raise deposit rates. So to your point, I do not know whether the deposit rates have peaked currently. We may see some more increase if the credit growth continues in the manner. And going forward, of course, one way which the banks have to think about, and some of us have already started doing, is to look at other instruments, market instruments, to actually fund our growth. Deposit, of course, is the most stable, but infrastructure bonds, for example, the other kind of bonds, those CPs, those instruments also can be used by the banks as if the rates there are showing a lower trajectory as far as deposits compared to the deposit rates. And currently that seems to be the case.
Right. So, sir, margin pressure will only increase going forward as rates come off. The banking system will see margin pressure. How should one read into loan to deposit and margins, if you can give us perspective?
So loan to deposit has been coming down because, as you have seen, many of the banks have very aggressively raised deposits, even if at higher costs.
Yes.
And have kind of tempered their loan growth, especially in the unsecured side. Some have even sold portfolios. And our, of course, CD ratio continues to be around 70% odd.
Right.
So therefore, we are relatively better. But there are other banks who have taken steps to reduce the CD ratio. Margin pressures, yes, will increase were the rate cut to happen. But we have to remember that the T-bill rate, the 3 T-bill rate, which is a key parameter for us, has actually come down from somewhere around 6.9 to somewhere around 6.6 or below. In fact, I think the last number was 6.47. So already about 50 basis point short-term rate has come down on the lending side, even without any RBI cut. So I think if the cut happens, this will further come down. And to that extent, deposits being priced with a lag, clearly the pressure on margins will initially be there.
Okay. And so, we had the governor also talk about the MSME loan growth that's been there, or rather NBFC loan growth that's been extremely strong, and some concerns with regard to processes, practices, policies that NBFCs have been using to lend, risk adjusted. You have a great pulse with how things are happening on ground. Just talk us through whether you believe that there are large gaps and what sectors should one be concerned about, or what sectors would you be concerned about?
So therefore, on NBFCs, I think the governor made a great point. One is that he acknowledged that they play an important role in financial inclusion by reaching out to unserved or underserved sectors where the ticket size is smaller, and therefore the banks will find it hard to actually reach out and have mechanisms to lend and also to collect. So that is therefore the importance of having this sector resilient. On the other side, he pointed out that wherever there has been a infusion of capital and the capital ratios are very high, and some of the NBFCs have been chasing growth for the sake of growth, basis the targets rather than actually seeing potential and therefore doing that. And once somebody does that, then there is always a pressure on using shortcuts, on seeing whether there is a sustainable risk management framework behind the and to back up the loan growth. I think those are the warnings he was issuing. As far as we are concerned, we see the entire gamut. There are, of course, NBFCs which are very well run, which are linked to some large corporate houses, and which are conservative and which are very selective about which segments they want to target. And we are very comfortable with them and their growth plans. And there are other NBFCs, of course, which are focused on the consumption side loans largely, unsecured loans, gold loans, and so on. And there we continue to monitor not only the portfolio, but also their risk management practices, their audit reports, and the external things, and the ASM, which is the the specialized agency for specialized monitoring, which are essentially firms which we hire to actually look at the portfolio and sample on the sample basis, look at the actual availability and the strength of the portfolio. So all those monitoring steps we are following. And of course, there is also one segment which is lower rated, where the growth numbers are high, and we are very cautious in terms of lending to such NBFCs. It's a full range. And that's what probably the governor also pointed out, that growth is okay, but if the growth is high on the basis of without having the adequate backup systems, that is a risky thing. And I'm sure the RBI, with their individual bilateral conversations with those NBFCs, are taking those steps to warn them about these kind of practices.
Excellent. Thank you so much, sir, for the perspective. It's always great having perspective from you on policy days. So thank you for coming in and giving us that.
Thank you. Thank you very much.
Okay, I want to switch focus. Real estate is the other one in terms of sector, doing very well in trade today. And we have with us Dhaval Ajmera, Director at Ajmera Realty and Infra, to talk to us, of course, about what the stance change and a possible rate cut could mean for the real estate sector. Of course, the sector absolutely buoyant. Welcome, Mr. Ajmera. Good morning. Just talk us through your view. If at all rates were to come off, do you believe it could aid the realty sector in India as of how you see it, despite the kind of base you're at?
So, we have been seeing a great surge in real estate over the last few years. And definitely the monetary policy has been one of the key factors for it to happen. And this being unchanged is a positive sign, because the stability is being seen in the market. Obviously, if the rates were dropping down, definitely this would have impacted in a very, very positive way with the buoyancy in the market, because somewhere cost of construction would have also been a little lower. It would have impacted over there in terms of inflationary cost going down. And overall, I think would have been a positive impact. But nevertheless, not being changed is also a positive, especially with this festive season coming right now.
And let me switch focus to your Q2 update. Just talk us through how realizations are progressing for you, because likely that's going to be a big driver to your top line going forward.
So realizations are moving positively. Our efficiencies are improving better. If you really look at, this year, this quarter has been more or less our sustenance sales, where all our projects have given a very sustained sales model all across. We've not dropped on the overall. As compared to last quarter, we did about 250 odd crores, and this year is about 254. But the most important thing is that we've had a massive rise in about 20% rise in our collections. And that is because of our efficiencies in construction and the work coming up faster, which helped us get better collection. So that's been the positive impact. And going forward, we are very buoyant on our, some launches which we've planned up over the next 2 quarters, which will definitely have a greater impact on our pre-sales numbers.
Yeah, very strong on that collections number, and even in terms of when I'm looking at H1 full rather than just Q2, your collections have gone up by 34%. The pre-sales guidance you've given is 1,350. How likely are you to exceed that?
Chances are very good. We are just praying and hoping. There are few projects which we want to launch, and with the elections coming around the corner in Maharashtra, and all these projects primarily are based in Mumbai, we are just hoping that the approvals come faster, because during this time there are usually government officers are on election duty, and sometimes it takes a hit on the approval processes. But we are still buoyant and hopeful that we will continue with our launches, and we will have a better sales than what we've planned.
Got it. And by how much would you exceed that if things were to go well?
Well, if things were to go well, fingers crossed, our plan is at least to go up by at least 5 to 10%.
Understood. Thank you so much, Mr. Ajmera. It's a pleasure speaking. It's a packed day. Thank you for coming in and speaking with us.
Thank you.
Right. With that, completely out of time on this edition of the show. From me, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
NDTV World Summit 2024, October 21st and 22nd, only on NDTV Network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target, what's good for long term, when to buy, when to sell. How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So happy.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit and my name is Alex Matthew. Like the name suggests, this show gets you answers to all of your stock-related questions and you will see a number at the bottom of your screen. That's where you send them to us. And if you are writing in for the first time, remember to tell us your name as well as the stock that you want to know about and the duration you'd like to hold it. It also helps if you tell us where you're tuning in from. Let's talk about where the markets are very quickly. Of course, the big event of the day is now behind us. That is the outcome of the two-day meeting of the Monetary Policy Committee. Status quo on rates is what was announced, but a change in stance was announced from withdrawal of accommodation to neutral. That was seen as positive. So you could see rate cuts sooner rather than later. At least that's the feeling that you get at the end of the Monetary Policy Committee's review. We will get more details on that at 12 o'clock when the press conference begins. As things stand, you have the Nifty 50 at trading very close to the high point of the day, up as much as 0.8% or thereabouts, and a break from the selling is what you're seeing. The broader market's doing even better. In fact, you have gains of about 1% or so for the mid-cap index, and you have gains of about 1.6% or so for the small cap index. All told, the breadth is very favorable. There are few sectors that are doing incredibly well in trade today. Among them, the Nifty Bank is participating in a big way. It's up as much as 1% or thereabouts. In fact, it's green across most of the screen today, and led by the Realty Pack, which is up as much as 2.5% or thereabouts. FMCG is the only sector that is not doing particularly well. It is down about 0.5% as we speak or thereabouts. I want to talk to you about transformers and rectifiers though, because that is what we had chosen for the focus, and I'll take you through very quickly some of the key highlights, because this is a stock that was gaining as much as 5%. It was up at upper circuit, and that's on the back of a very strong set of numbers in the second quarter. The revenue has grown as much as 80%. You have EBITDA growth of as much as 255%. The PAT has grown 2.4x. A significant inflow of orders, 1,000 crore rupees has come through. That's 48% higher than the previous quarter and as much as 228% year on year. What is very interesting is that the order inquiries under negotiation, that is currently being negotiated, that stands at 18,500. And so even if it converts 20% of that, you're still talking about an order inflow of over 3,000 crore rupees, which is quite significant. So let's find out what our experts have to say about that. Ashish Maheshwari, Director at Arihant Capital Market, and Vaishali Parekh, who's Vice President Technical Research at Prabhudas Leeladhar, joining me on the program today. Thank you so much to the both of you for taking the time, and thanks so much for your patience. I'll come to you, Ashish, first on transformers and rectifiers. There are some that are saying there's a potential upside of 40+% from here. Is this a stock that has gone up 3x over the last year, up 10x in the last 2 years? The question that some investors will ask if they've not gotten in, is this not too costly?
If you ask me, as far as the industry is concerned, the industry is doing very well. These companies are flushed with the order inquiries and order book because a lot of reforms or a lot of investment is going in the power sector. And if we see particularly like all these replacement transformer demand is very high. At the same time, solar transformer demand is also quite robust. And this is the reason so many, almost 1,000 crore worth of inquiries Trill is also having. Only my apprehension is the stock has moved too fast from, if you see from 52-week low to high, from 150 stock went almost up to 850. So huge returns this stock has given to those investors who have who are holding it or they have invested at lows. But in my view, now we need to wait for some time and wait for some correction to enter the stock. Because at 9,000 crore market cap, I find slightly valuations are stretched. So maybe 600 or 550, if you ask me, will be a prudent price point to enter into this stock.
Okay, fair point. All right, it's time to jump into the queries, and sorry to have kept all of you waiting. We've got the first question coming through from Abhishek. Sorry, it's Chandrasekhar who's asking this first question. He's asking about Canfin Homes. The stock is currently trading at 872, and he's asking whether he can make a fresh buy here. Vaishali, on the charts, does it look attractive?
Hi, very good morning. So I would say right now, of course, we have seen a good corrective move coming in. So for now, the trend is pretty much intact. 800 is the 200-day moving average level. So I would say accumulation would be a better strategy rather than just buying in just one.
I'm coming back to you on Adani Ports, and this is a question coming in from Mutanna, who's writing in from Bengaluru. He's asking for a one-year perspective on Adani Ports. The stock is up about 0.7%, trading at just above 1,400. It's done reasonably well. If you talk about the large caps, and in that context, it's up as much as 40% in the year so far. Would you buy, though, from a perspective of 1 year? Vaishali, this one's for you.
Yes, so I think it is hardly participated in the rally that we have witnessed so far. And I think the long-term trend is also intact. So I would say, yes, these are good levels to start accumulating. But with the geopolitical issues, the stock can dip towards 1380, 1350. So I would say, once again, that start accumulating because it's a fair value technically.
All right, a quick update and the standard disclaimer. This is NDTV Profit, part of the NDTV Group, which is owned by the Adani Group. Let's talk about the next question then, and this is from Abhishek. Abhishek is asking about Nandan Denim. I'm curious about whether you have coverage on this one, Ashish. If you've got a coverage, would you suggest a fresh buy? It's a very tiny company.
So Nandan Denim is concerned, this is I think penny stock now. 6 rupees is the price. So market cap is almost 1,000 crore because there's 1 rupee paid up stock. But my view is this is not still the right time to venture into such stocks. And my advice will be to go for quality stocks only in this space. So if somebody is keen to enter into textile only, I think companies like Raymond's or Himmat Singha Seed, etc. We need to focus more on there instead of Nandan.
If you broaden it to the apparel space, would you say something like a Trent is attractive at this level, Ashish?
Yeah, Trent is surely attractive, and we have seen also the strength that in falling market also stock has done reasonably very well. And though stock is quoting at more than 100 plus price earning multiple, but quality is quality. So nowadays more and more investment is going for quality stocks, or where growth is clearly visible instead of commodity play like that only. So surely Trend can be always a good bet.
Long term, though, remember that this is a stock that is done incredibly well, and it is not cheap by any stretch of the imagination. Marulappa Arasekare is asking the next question, and I hope I got your name right. Loris Laboratories is the name of the counter. He's bought 473 at about 2,000 shares is the quantity. Vaishali, I'm coming to you on this one. The question is, should he hold or should he exit?
I think he should hold because overall full pharma and the healthcare stocks are doing very well. So I would say that hold with a stop loss of 420 because the way market is attempting to buy bounce back, this too can bounce back at least for a near-term target of 500, 510. So with a stop loss of 420, hold on.
Okay, all right. Let's take the next one from Saikiran Jaluri, who's writing in from Hyderabad, and he's asking about Hudco. He's asking about several companies, but I'm going to choose one of them. Remember, we can only take one stock per viewer. Ashish, I'm coming to you on Hudco. What would you say? This is a stock that has doubled over 12 months. Another one that is too expensive at this point, or would you say that it can still be bought?
Because the stock which has let down investors, particularly those investors who have bought it at the peak. Because there's again a stock from 70, 80 rupees went to up to 350. Now, as all PSU stocks are going down, this is again a stock which is languishing between 200 to 240 for quite some time. And mind it, these are the PSU stocks where a lot of retail traders have struck up and they became investors. So on all rises, you are going to see a lot of liquidation in stocks like Hudco or Engineers India, etc., where retail investors are badly stuck up. So my suggestion will be to exit from this stock. I'm not expecting any major move here.
Yeah, okay, fair point. Hariharan V has asked about Loris Laboratories. Hari, we just got your view on that. Vaishali spoke about it. He's also asking about Geo Financial Services, though, and I'm curious about what you think about this particular counter. It's trading at 346. In fact, let's pull up the year-to-date chart. And it's done about 50% or thereabouts just this year. Of course, not much can be said about the fundamentals yet. There has been approval that has come through on the AMC side, the SEBI approval for the Geo BlackRock AMC. But let's see when that takes off and how action moves on the ground. Purely on the technicals, though, would you get into this counter, Vaishali?
Say so. Actually, even technically, there isn't much happening. I mean, it's going through a very long consolidation. So I would say that 320 anyways is a support very close to the current market price. And I think it makes a good buy at these levels because once the stock goes above 365 and it sustains, that means that it's picking up strength and it would get into a trend. And then perhaps one can look for a target of 380, 400 to start with. So, of course, no harm buying at these levels.
A view on JFS. We're going to take the next view on Camlin Fine, and a technical view is being sought because it's only a view. Apologies. It's actually a view that is being sought for 2 to 3 years. So I'm going to come across to you, Ashish. This is Surya from Bengaluru. He says he's a keen watcher of the show for a long time. Thanks so much for that, Surya. Means a lot to us. Would you buy Camlin Fine, though? For the perspective is 2 to 3 years, Ashish, on the fundamentals.
No, if you ask me, I'll not like to buy because if I see the fundamentals, companies incurring losses quarter over quarter. We have seen 34 crore given for loss last quarter also, and before that also. So why to invest in a company which is incurring such a huge losses? So it's a avoid in line.
Avoid is a view on Camlin Fine. Would you have an alternative that you would invest in instead on the fundamentals in the same sector?
Yeah, I like to go for a company like Anupam Rasayan, which can give you better returns than Camlin Fine.
Okay. Fortis Healthcare is the name of the counter. This is a question coming in from Subramaniam, who's writing in from Chennai, and he's bought at a price of 156, asking whether it can be accumulated at the current market price of 606. So he's got an incredible buy price, Vaishali, and I'm guessing that he's been holding for some time. The question is, should he add more at this point?
Not at this point, wait for some retracement because it's already bounced from its support levels. And I would say once if the stock furthermore dips towards say around 570, 560, that would be an ideal level to add more. And as I maintain that healthcare and pharma should continue to do well. So I don't see any reason to panic in this stock, but look for ideal levels to get in.
Okay, Idea Forge is the next counter. That's the question coming in from Karthik. I agree, who's writing in from Vishakhapatnam. Ashish, on the fundamentals, he's looking for a long-term view. He hasn't gotten into the counter yet. The stock is currently trading just shy of 680. Would you buy at this point?
No, I'll not like to buy. Again, we have seen a lot of scaling in this stock from 850 levels. If you see 50 to be close around 620. So still not too much action in this stock after the IPO euphoria. And we have seen also the performance in the last quarter profit from 11 crore to just a crore rupees. So it's still expensive in my view. It's an avoid.
Okay, it's an avoid. All right. Mahindra and Mahindra. Shankar from Bengaluru's got a question on this. He's asking whether it can be, or rather actually he's saying that he's bought, I believe today, 3,165 is the value that he has managed to get. What is the target that you would ascribe to this? Ashish, it's interesting because I saw a brokerage note not too long back, which, if I'm not mistaken, a potential upside of about what, between 13 and 15%. I'm not sure about that, but I know that they changed their stance to buy. I will have to remember what I'm talking about. What would you say? Because they were talking about an improvement in the automotive segment in terms of the margins, and they're also banking on an improvement in farm equipment because they say that agri growth will take place because of normal monsoons, and that leg of the business will start, firing on all cylinders as well. Would you agree with that?
Yeah, I fully agree with that. And tip of the iceberg is again the Rocks booking. Their new car, which got almost 1.75 lakh booking in 1 hour. Just imagine the kind of sales this company is going to report in the next coming years. And another thing is, if you see when the quarter over quarter, from March to June quarter also, we saw almost 500 crore profit was added from quarter over quarter in this company. And no wonder this stock is at near 50-week high, almost of 3,200 rupees. So it's a bullish. I'm very bullish on this in short, medium, long term. I think this stock will continue to deliver. Even your chart is showing 1 month 17% odd return in spite of such a fall in the market recently. So stay invested here.
Stay invested is a call on Mahindra and Mahindra. All right, Darshan Mandviwala, who's writing in from Surat in Gujarat, wants to invest 20,000 rupees in Oil India. What is the best entry price for this stock? The stock, will it be able to race up to 700 to 850? The question is that. The stock is currently trading at 566 or thereabouts. He has already bought at this price. 5,000 rupees is what he has deployed. What should he do with the rest and how should he deploy? Vaishali, what are the key levels to deploy at?
I would say, the trend is pretty good and there's nothing really happening currently. So 530 acts as a good support level. So I would say he can put in the money right now also.
You can put in the money. Any targets that you would ascribe to this though, Oil India?
Well, so I would go step by step. The first target that one can look at is 630. Once we see a move above that and sustaining above that, this can go towards 750 also. So yes, for a long-term pick also, I think it makes sense.
Okay. Let's run through a few more. We've got Sibi from Chennai in Tamil Nadu who's asking about Paisalo Digital, which Sibi has bought at a price of 54. Let's pull up. Yeah, so that's where the price is right now. Would you hold on to that, Vaishali, or would you sell?
I'll just have a look.
Yeah.
So Pesalo, I think the trend is quite corrective. We may at the most see a bounce. So for now, I would say exit on bounce.
Bounce is a call on Pesalo Digital. IREDA is the question or the stock that Naresh from Vijayawada wants to know about. He's bought at levels of 230. IREDA, interesting space, a lot happening. PFC REC also similar space. Growth is absolutely tremendous in the book. The stock is gained tremendously. Ashish, would you hold on?
Yeah, I like to remain invested in IREDA because it is still a better bet compared to other PSU pack. And again, fundraising plan and all those things will keep buoyancy in this stock. So if you ask me a few stocks which I like in PSU, I think IREDA, HAL will be my couple of top picks. So remain invested here, or even can be bought at this.
Okay, can be bought at this price. Ashish, you've already spoken about M&M. What's your view on Tata Motors? Because a short while back, you had an update from Jaguar Land Rover. It said wholesale sales will pick up in the second half, but retail sales were a bit of a problem in Europe and China. Would you buy this point?
Yeah, I think the sales is going to pick up because the kind of stimulus China is giving to their economy. Ultimately, sales is bound to pick up for cars and consumer durables, etc. And at the same time, post-US election also, we may see good response and further sales in vehicles there. At the same time, the rate cut will also help the companies like Tata Motors. So, in my view, if somebody is having at least even 3 to 6 months time frame, 10 to 15% as upside, we can expect in Tata Motors.
Okay, Tata Motors is positive, or rather Ashish is positive on Tata Motors. Thank you so much to the both of you for joining in, for taking the time. Pleasure having you always on this program. All right, we have to slip into a very quick break, but on the other side, we've got more action lined up. We've got the press conference from the Reserve Bank of India to talk about the announcement that was made a short while back, the outcome of the MPC. So do stay tuned for that.
NDTV World Summit 2024, October 21st and 22nd, only on NDTV Network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Hi, thanks so much for tuning in. You're watching live coverage of the RBI monetary policy on NDTV Profit. We've had the big headline since morning, and that is the rates have been kept unchanged. And the Monetary Policy Committee, the newly reconstituted Monetary Policy Committee, has voted 5:1 in order to keep the rates unchanged at 6.5%. There's also a change in stance, and that is the other big takeaway. The change in stance has taken place from withdrawal of accommodation to neutral, which is quite a big shift as well. Let's take a look at where the markets are right now. And just over the last 15 minutes to 20 minutes or so, you've seen a little bit of cooling off in the benchmark Nifty 50 from the high point of the day, which is 25,234. We're now trading about 100 points below that, but holding above 25,100 or thereabouts. There is strength in the broader markets today, and you have the mid-cap index that's gaining about 1.2% even as I speak, and you have the small-cap index that's up about 1.3%. It has given just a bit of ground in the last 15 minutes to 20 minutes or thereabouts, but it's still trading buoyant. All of the sectors, rather most of the sectors, are trading in the green right now. There is participation from the Nifty Bank, crucially, but you also have energy in the last few minutes that has given a little bit of ground up. You have FMCG that is down and has been an underperformer in trade today. But let's talk about the key gainers. You have the realty pack as a whole that is doing incredibly well, up as much as 1.7% in trade. A few key developments being announced by the companies in the sectors. You have positive numbers that have come through for the second quarter that have been viewed positively. You have the likes of Phoenix as well as Macrotech and Prestige that are leading gains, but Oberoi Realty also looking strong, up as much as 1.8%. Now, let's talk about a few of the key takeaways from the RBI monetary policy announcement just a short while back. Of course, I was talking about it earlier when I said that the rate was unchanged at 6.5%. The stance was changed to neutral, which is quite a significant move and generally is seen ahead of a change in the monetary policy direction. We're not calling it yet. We don't know when the next action will be to cut the interest rates, but it may not be too far off, especially in the context of what is happening globally. But domestic factors that you need to focus on, and this is what the RBI monetary policy is all about. You have the Reserve Bank of India governor that will be speaking about it in just a few minutes. Inflation continues to be something that the RBI and the Monetary Policy Committee are watching very, very closely. Food inflation continues to be a bit problematic, but core inflation has bottomed out, according to the Reserve Bank of India governor. When he made that statement, he spoke about the fact that the outlook for inflation has been kept unchanged at 4.5%. So there you have it, the press conference just a couple of minutes away, the usual photo taking before the start of the presentation of the key takeaways by the Reserve Bank of India governor. We'll go to that in just a minute. By the way, the growth outlook also being kept unchanged at 7.2%, and that was another key takeaway. All told, it's looking good for the Indian economy, according to the Reserve Bank of India governor. He's saying that there is a good balance at this juncture between inflation and growth, and several factors have led to positive triggers for the Indian economy on the growth front, and that has allowed the RBI governor and the MPC to focus on inflation. Let's head across to the RBI governor now to see what he's saying.
So we may start, sir. Are there less number of people today, or is the
24 is the same number?
Maybe it's a bigger hall, that's why it looks different.
We are ready to get 2 people if you are
No, maybe in future, if we are doing it here, we could consider that. But please go ahead.
Sir, thank you, sir. So hello and good afternoon. Welcome to this post-monetary policy press conference in this new setting. Friends, we have with us Governor Reserve Bank of India, Shri Shaktikanta Das, Deputy Governors, Dr. M.D. Patra, Shri M. Rajeshwar Rao, Shri T. Ravi Shankar, and Shri Swaminathan J. We also have with us Executive Director Shri Dr. Rajiv Ranjan and other colleagues from Reserve Bank. To begin with, I would request Governor Sir to make his opening remarks. After that, we will have the question answer session. Sir, please.
Thank you, Puneet, and good morning and welcome to all of you. As I already said, season's greetings to each one of you. These are main highlights in my monetary policy statement. I'm not going to say anything new drawn from the MPC. So I would like to make about totally 9 points, and I'll be quick. First, India's growth story remains intact. Second, inflation is on a declining path, although we still have a distance to cover. There are significant risks to the inflation outlook, and these risks cannot be underestimated. We need to remain vigilant. Number 3, the balance between inflation and growth is well poised. Number 4, the external sector remains stable and reflects the strength of the Indian economy. 5, forex reserves are scaling new peaks. 6, the financial sector remains sound and resilient. 7, the Reserve Bank will continue to be nimble and flexible in liquidity management operations. 8, today's monetary policy action gives greater flexibility and optionality to the MPC to act in sync with the evolving conditions and the outlook. I'd like to repeat this. Today's monetary policy action gives greater flexibility and optionality to the MPC to act in sync with the evolving conditions and the outlook. 9, we are acutely aware that there is no room for complacency, especially amidst the rapidly evolving global conditions which encompass geopolitics, financial markets, and commodity prices. Thank you.
Thank you, sir. Before we begin, I will request our media friends present here to please wait for your turn. You may see my colleagues on both sides of the aisle with mics in their hand. So as I call out your name, they will hand over the mic to you. In the interest of time, humble request, please restrict to one question per person. And if time permits, we may consider some other questions. Sir, as mentioned, sir, there are 24 participants from media today. And with your kind permission, I'll call out the names. So I'll start with Ms. Lata Venkatesh from CNBC.
Lata Venkatesh from CNBC. Thank you very much for the opportunity. Thank you, Governor. Even if you cut, do you think, as and when you cut, do you think the fact that deposit rates are, acutely being fought for and are high, do you think it will get percolated at all, and therefore, or transmitted at all? And therefore, what is your assessment of when deposit rates may peak off? Have they peaked off?
You see, the interest rates or the policy repo rate, the decision of the MPC will be determined by the growth inflation dynamics. And we have been saying that repeatedly. Depending on the overall inflation outlook and the growth outlook, as mandated under the monetary policy, the interest rates, the MPC will decide with regard to the policy repo rate. Now, the lending rates, the deposit rates, and other money market rates naturally will move in tandem or in response to the interest, to the policy repo rate decided by the MPC. MPC, of course, takes into account multiple factors. Financial stability aspects and other aspects are taken into account. While primacy is given to inflation outlook and growth, MPC does take into account several other factors. But money market rates, including deposit rates or credit rates, they respond to the policy. and all factors are kept in mind by the MPC before taking decisions. No, I can't say whether interest rates or the deposit rates, the credit rates or the deposit rates are peaked. It's for the lenders, the banks and NBFCs to decide. These are commercial decisions in response to the overall economic conditions.
Thank you, sir. We'll have Mr. Manojit Saha from Business Standard.
Good afternoon, sir. Now you have changed the stance to neutral, while you have said that the moderation in headline inflation is expected to reverse in September and going to stay elevated. So the elephant has not really come back. He's still around. I mean, he's still in the forest. So why the change in stance to neutral when inflation is expected to stay elevated?
I think you missed the shift from elephant to the horse. The horse, with lot of effort, the horse has been brought into the stable. We cannot, we have to be very careful before opening the gate of the stable, because there is every chance that the inflation horse will simply bolt again. We have to hold it in tight leash and have greater confidence and alignment of the inflation with the target. But specifically, what was your question?
Why the change in stance at a point when inflation is expected to stay elevated?
No, you see the near-term outlook, if you see the statement, if you read the statement carefully, what we have said in the statement is that September it is going to be high. The data will be released on Monday. October also it is expected to remain high, maybe around 5% or so, and mainly on base effect factors as well as uptick in certain components of food inflation. So in the near term the inflation is remaining high, but thereafter there is moderation going into the third quarter. And also we have given the number for the for the third, fourth and also for the first quarter of next year. So we have now greater confidence that inflation is moderating, but we are acutely aware that there are significant risks. I have made a reference to the data released just about a week ago by the FAO and the World Bank with regard to the commodity prices, including food also. We have to be very careful. So therefore, we have changed the stance at the moment because we see that growth and inflation, they are well poised. The balance is well poised. So the MPC considered it appropriate. The timing is appropriate to shift the stance to neutral.
So it's a pivot.
No, that is for you to assess whether it's a pivot. And neutral stance, as I said in the statement, it gives us optionality and flexibility to take decisions.
Thank you, sir. We'll have Mr. Anup Roy from Bloomberg.
Thank you, sir. Governor, you changed the stance and you gave a very strong statement that inflation, you are seeing some durable signs of inflation moderating towards the target. Given that you prefer clear communication and transparency, is that a very strong signal for a rate cut or pivot in December policy or even before that out of policy?
I think I'll request Deputy Governor Michael Patra to take that question.
So you should just assess the stance by itself, independently. So we, as Governor mentioned, we will like to see off the near-term hump in inflation, which we all our projections suggest is going to happen. We want to see it off carefully before even considering the next move. So our whole attention is now focused on this near-term hump.
Thank you, sirs. Next, we'll have Ms. Swati Bhatt from Reuters.
Thank you so much, sir. So I just wanted to understand, India is now included in all the three emerging markets.
Just keep it a little closer.
Okay, is this better?
Yeah.
Governor, I just wanted to understand, so now India has been included in the FTSE Russell index as well. We already were included in the JP Morgan and Bloomberg index. to what level are we comfortable in terms of these foreigners owning government bonds? Is there a comfort level that the RBI has? If you can just briefly explain that. Thank you.
I think you can reply.
So the current holding of government bonds by foreigners is just about 3%. So even the question of what is a sustainable level doesn't rise. Even under the various routes, it's very, very low. For instance, under the FAR, it's just about 5.5%. So we will wait for these numbers to, get to a decent level before we take a view.
Thank you, sirs. Next, we'll have Mr. Ashish Akashe from PTI.
So why have you retained the growth target at 7.2%, and what you are estimating that the second half there would be an acceleration in growth? Why are you expecting that to happen?
So I think I have explained it in my statement. I mean, the drivers of growth, the critical drivers of growth, that is consumption and investment, they continue to be quite stable. Private consumption, we saw in the first quarter data, was far better. And investment also, the numbers are looking good, and private investment is showing signs of pickup. In fact, going by the investment intentions of the corporates, given their deleveraged balance sheets, the government capex, going by all signs, I think private capex as well as the government capital expenditure is also doing well, and the services, services sector is also continuing to do well. And further, agriculture is going to provide a big boost this time, not only on the supply side, but also to consumption demand in the rural sector. The monsoon southwest has been very good. Expectations of a good, the expectations of a good Rabi output are also fairly strong, thanks to high reservoir levels and the moisture conditions of the soil. So rural demand is expected to maintain its momentum. Urban demand remains steady and will get support from buoyant services sector. So if you put all these things together, I think it gives us, the number that we get is 7.2%. And as I have already articulated, the first quarter numbers should not be, which came at 6.7%. It was primarily due to lower expenditure by both central and state governments. Maybe because of it coincided with the election season. In fact, but we now get a sense that both state and central government expenditures will meet their budget figures, will meet their budget estimates. An important aspect also, which has been perhaps missed out, but which was highlighted in the State of Economy Bulletin article of which was released in September, in the last month's bulletin article. Now, if you the first quarter, the subsidy payout was very high by the state governments in particular, and also to some extent by the central government. So GDP is basically GVA plus subsidies, plus indirect taxes minus subsidies. That is plus indirect taxes minus subsidies. Subsidies were very high. In fact, if you take out the effect of the subsidies, the GDP growth would have been quite above 7%. I do have the number, but I don't want that to be a headline. The actual GDP growth would have been upwards of 7%. But that is a statistical aspect. We don't go by statistical factors. We go by real economic activity at the ground level. And I have just explained why we are sticking to 7.2%. We just have the first quarter data. Second quarter data will come only in the end November. Second half of the year is just beginning. And our sense is that the growth is maintaining its momentum. So that's why we are sticking to 7.2%.
Thank you, sir. I would now ask Ms. Sangeeta Mehta from Economic Times.
Thank you, Governor. So, the feedback that we get in our conversations speaking with NBFCs is that the credit to GDP ratio in India is still very low. So in that context, the observation that RBI has made that there is a push effect rather than the actual growth. How do you arrive at this? I mean, is it because that there is a huge substantial rise in NPA, or is it that there are some other findings that RBI has?
You see, the push effect is confined to certain NBFCs. I am not generalizing for the whole NBFC sector. I said it also very clearly that the overall NBFC sector is doing, is maintaining good, remains stable and has good health. But more specifically, I would request DG Swaminathan to reply to that question.
Yeah, thank you, sir. So as Governor said, this particular messaging was for a set of players on the one hand, on the other hand, to certain select segments in which we see an outlier growth. And these segments were called out earlier as well in our last year's prudential action. And the commentary that you would see from the June data as well as July-August numbers, September numbers are still awaited, is that there are certain elevated slippages and little higher credit cost being seen in select segments. So the messaging is targeted towards such of those NBFCs which are pursuing a high risk, high growth strategy, and also to certain segments which are likely to get into stress in our estimate. So it's not a generalized message, so it has to be seen in that context.
Higher risk weights will come.
No, you have to wait. You have to wait for that.
You have to read the governor's statement. The last line very clearly says we are watching the incoming information and then take measures as may be appropriate. It's again contained in the statement itself. The three segments have been already mentioned in the statement.
Yeah. Thank you, sirs. I'd request to please speak in the mic, because here, if you don't speak in the mic, people won't get it outside. Next is Ms. Hamsini Karthak from Money Control.
Thank you, Governor.
Mic closer, yeah.
Thank you, Governor. My question is actually a continuation on the NBFC side, more specifically to microfinance loans. Microfinance as a pocket is getting considered as a 7 to 9% credit loss kind of a sector. And most of the players in the industry believe that that can be priced in. The risk can be priced into the interest rates as well, which is having somewhere a counterproductive effect on the rate of interest. Partly you called it out today as well. To counter that, is there something that you which is in the works that you would be looking at? Because and how much do you believe in the current market that pricing the risk is quite possible for you all? If I can add on to the question, the microfinance industry has also, whether banks and NBFCs, they put forth for some revisions to the norms that came out a couple of years back. Is that under consideration? Would you be open to amending some of the norms there?
I think I would request DG Rajeshwar Rao to take that question.
No, I think there is no real contradiction in the issue which we are highlighting. The lenders are expected to price the true risk of exposures, and interest rates cannot be disproportionate to the risks. The higher credit losses which you are referring to possibly reflects poorer underwriting standards, and that's exactly the message we have been giving, that the underwriting standards have to be strengthened so that the risk is properly priced. If that happens, then there is no real contradiction and the borrowers will get the rates which are more appropriate. As regards the feedback on the MFI guidelines, we are getting feedback. We will review at an appropriate time and see if any revision is warranted at that juncture.
Thank you, sir. अब मैं जी बिजनेस से श्री ब्रजेश कुमार को आमंत्रित करूंगा अपना प्रश्न पूछने के लिए.
थैंक यू सर. सर, आपने एनबीएफसीज के बारे में बात की कि ग्रोथ एट एनी कॉस्ट, लेकिन हाल में कुछ ऐसे इंसिडेंट्स हुए हैं जहां पे बैंक स्टाफर्स को सुसाइड करना पड़ा. एटलीस्ट दे क्लेम कि उन्होंने सुसाइड किया इस वजह से क्योंकि उन्हें बहुत सारे टारगेट दिए जा रहे थे जो मीटअप नहीं कर पा रहे थे. तो आपने एनबीएफसी पर तो बात कही, लेकिन बैंक वाले पार्ट पर भी क्या आपको ऐसे इनपुट्स हैं या आप कुछ सोचेंगे इस बारे में?
देखिए, मैंने भी देखा न्यूज़पेपर में जो इंसिडेंट, एक दो इंसिडेंट्स जो है उसके बारे में हम लोगों ने भी न्यूज़पेपर में देखा है. और हमारा सुपरविज़न जो है वो बहुत इफ़ेक्टिवली और बहुत डीप सुपरविज़न वी आर डूइंग, एंड वी आर एंगेज्ड विद द बैंक. 2 या 3 इंसिडेंट के ऊपर हम बिल्कुल जनरलाइज करने के लिए सिस्टम के लिए जनरलाइज करना ठीक नहीं होगा. जो 1-2 इंसिडेंट हुआ है उसमें क्या फैक्ट्स थे वो इन्वेस्टिगेटिव एजेंसीज जो है वो उसका जो है वो इन्वेस्टिगेट कर रहे हैं, वो नतीजा उसमें निकलेगा. लेकिन 2 या 3 केसेस में आप जनरलाइज नहीं करना चाहिए. और उसके साथ साथ मैं ये भी कहना चाहता हूँ कि हम बिल्कुल जो फेयर प्रैक्टिसेस कोड है, रिजर्व बैंक का जो फेयर प्रैक्टिसेस कोड है, जिसको कि ना केवल NBFC बट बैंक्स दोनों को फॉलो करना चाहिए, वो किस हद तक फॉलो कर रहे हैं इंडिविजुअल एंटिटीज़ या नहीं कर रहे हैं, उसको हम रेगुलरली मॉनिटर करते हैं. और जहाँ जहाँ हमको कुछ कमियाँ दिखता है, हम वो जो रेगुलेटेड एंटिटी है, बैंक हो या NBFC हो, उनके साथ टेकअप करते हैं. और पास्ट में अगर देखेंगे हमने कई सारे एक्शन भी लिया हुआ है, इंक्लूडिंग मॉनेटरी पेनल्टी लगाया है और उसके साथ साथ कई केसेस में बिजनेस रिस्ट्रिक्शंस भी हम लोगों ने इंट्रोड्यूस किया है.
धन्यवाद सर. अब मैं नाउ आई आस्क सिद्धार्थ उपासनी फ्रॉम इन्फॉर्मिस्ट.
Thank you, sir. Afternoon, Governor. A fall in global crude oil prices was really helpful for bringing down inflation post 2014 when the framework was adopted. In the MPR, I think you have reduced your assumption for crude oil from 85 to 80 for the second half of the year. But has it become now, in these circumstances, in these new global dynamics, has it now become more difficult to rely on crude oil prices to bring down inflation domestically? And has it become a lower, smaller consideration in interest rate decisions? And just the second one regarding the MPC external members, you're part of the selection committee. Was there any conscious effort from the selection committee to look beyond experts in macroeconomics, inflation, interest rates, and monetary policy? Thank you.
No, I cannot comment, or I would not like to, mention about the deliberations of the Monetary Policy Committee. These are internal deliberations of the committee. It would not be appropriate, it will not be proper for me to comment on the internal deliberations of the Monetary Policy Committee, and the recommendations of the committee go to the ACC for approval, so it won't be appropriate. So I will not comment on that. With regard to the first part of your question, I would request Deputy Governor Patra to take that.
Okay, thank you, Governor. So if you've noticed in this current period, the oil price went to 70 on a certain day, and now it has come down to 80. And you rightly observed that we have changed our assumption regarding crude oil in the MPR. But if you look at a more medium-term perspective, you'll see that the outlook for crude oil prices is actually softer than it is today. And the reasons are that, one, OPEC Plus is planning to restore production cuts in a phased manner through 2025. Then the International Energy Agency estimates that the demand for crude oil is actually softer than it is now. The third thing is that increasingly renewables are gaining a greater share in electricity generation and power and all that. So all these factors make out for a softer outlook on crude oil.
Thank you, sir. Mr. Mayur Shetty from Times of India, you have a question, please.
Governor, last year when you paused the rate hikes, you had made it very clear that that's a pause and not a pivot. This time you're leaving it open. You're saying that you're not commenting on whether it's a pivot. But at the same time, there is the stance has changed to neutral. So how do we see this? Is this a baby step towards easing, or is this completely independent from rate action?
No, you see, today we are in a position, I think I replied that I said that in reply to another question from Monojit. Now, the growth and inflation, in fact, I have said it in first part of my statement also, that the fact that growth inflation are well poised goes a long way to show that monetary policy framework, the FIT framework, flexible inflation targeting framework, is working and has proved its mettle. Now, in such circumstances, when both inflation and growth are well balanced, there was no point in continuing there was no justification to continue with withdrawal of accommodation. We have achieved what we wanted to achieve. Now the future path is full of uncertainties, which I have listed out, and these uncertainties and the risks cannot be underestimated. And while we have Again, I am repeating myself that we have given the projections. While we have greater confidence that inflation is moderating, but considering the significant risks that lie ahead of us and which are staring at us, it will be inappropriate, it will not be appropriate to specifically sort of talk in terms of timing of a rate cut. We have to be very careful about opening the gate of the stable. Thank you.
Thank you, sir. Next, I'll ask Mr. Ankur Mishra from ET Now.
Thank you, sir. Sir, last few policies, there were warnings on banks too. This time you have given warning to NBFCs regarding the specific cases which you may have observed. I want to understand that with the actions which were taken by Reserve Bank of India and also the warnings which were given, has the desired result been achieved so that this time there is no mention of bank? And overall also, what is your assessment that yielded results have been found by the regulator, which was warned by you earlier? And also, sir, another thing, don't please consider as a question, what is the reason you have changed the animal from elephant to horse this time?
The reason for shifting from, it's not a shift. The reason for, earlier I used elephant, this time I am using horse. The reason is that it's a war against inflation. And in a war, elephants and horses are used historically. Thank you. I think DG Swaminathan can take the main question.
Yeah. So, thank you, Governor.
No, Arjuna will come when there is a requirement. Arjuna, with his Brahmastra or with Narayanastra or the various astras that Arjuna has, will come back if and when necessary. But at the moment, we remain unambiguously focused. I have said that. But on a serious note, I think DG Swaminathan, please.
Yeah, thank you, Governor. See, as regards any regulatory or supervisory action is expected to have the intended impact. And as we have seen in the past as well, that the institutions do respond to the messaging that we do. So that way, whatever steps that we have taken, whether it is regulatory, prudential or proactive measures or supervisory actions that we had initiated, all of them had a good effect and also a demonstrative effect in terms of the rest of the industry also falling in line with the regulatory guidelines. So we have no doubt on that effort. But that doesn't mean that we can be complacent. So we continue to remain watchful, and we, through both our on-site examinations as well as off-site data analytics, we keep watching the behavior of various institutions through various segmental actions. We will take steps that are as may be necessary. And in each of the speech, a certain theme is given, focus is given for aspects that are considered relevant for that month. So at certain point, we were messaging to the banks, and today, because these are 2-3 items that were more relevant to NBFC, it was highlighted. But if you have observed it closely, the closing of that paragraph was covering all institutions, not just NBFC. So the messaging is common. Thank you.
And also, just I would like to add, which is again there in the statement, we don't treat banks and NBFCs or any other financial institutions as adversaries. We work closely with them in a spirit of cooperation, and as I have said in my statement, we always expect self-correction, and we give enough time to whether it's a bank or an NBFC, to take necessary corrective measures at their end. We encourage them to do that. So it's not an adversarial relationship, but as a regulator and supervisor of the financial system of the country, it's our duty to point out where we see possible or potential risks becoming more serious and advise them to take corrective actions.
Thank you, sirs. Next, I'll request Mr. Sachin Kumar from Financial Express.
Sir, good afternoon. Recently, RBI came with this circular saying that there was irregularities in disbursal of gold loans. So I wanted to understand this: how big was this problem, and which segments of in the sector, for example, banks, fintechs, NBFCs,
who were, where did you find this things happening more? And if we go back little back, so we have seen that you have taken actions also with regard to KYC and ITs. So the second part is there are you seeing an increase in tendency to overlook norms?
I think Deputy Governor Swaminathan can take that.
Yeah, see the gold loan circular that you are referring to,
Into the mic. Yes. Draw the mic closer. Yeah.
So the gold loan circular that you are referring to was issued on the basis of
little nearer, little closer, because the mic will not, TV will not pick up. Yeah.
See, the gold loan circular that you are referring to was issued after extensive on-site examination of various financial entities across the spectrum, and also on the basis of the data that we had collected through the off-site data monitoring systems that we have. On that basis, we had observed certain deficiencies in the conduct of gold loan portfolio. So I think the details are already available in the annexure to the circular. So there's nothing more that I can add to other than what has already been mentioned in the circular. And this has been a messaging to all the other participants to set right their policies, processes, and we have given certain time frame within which we expect them to set right these deficiencies, and we will examine it in due course to see to it whether there is a adherence to the guidelines as expected. The second part of your question, that whether there is a tendency to overlook regulations, but I don't think so. It's not something which is widespread. These are observations that are relating to a few institutions. So we engage with them bilaterally, and we will take supervisory action on those entities on a bilateral basis. But this messaging is for the rest of the industry is more has to be seen in a generic term, and not to be construed as overall non-compliance. These are certain outlier behaviors that get highlighted through these instructions.
Thank you, sirs. Next, I'll request Mr. Ben Jose to ask his question.
Good afternoon, sir. You have said that the growth rate is robust and there is no risk to growth. But the latest PMI numbers, both in service and manufacturing, it shows a steep deceleration from the services is at 9-month low and manufacturing is at 10-month low. Still in positive territory, but then are you taking this as just a one-off, or and the outlook of the industry is also negative for getting new orders? So is it a one-off, or why your growth outlook remains robust and retain the rate, but there are ground level indicators showing the other way?
You see, at any point of time, there will be push and pull factors. There will be factors which are, where the activity, economic growth may be slowing down. There are areas where the economic growth will be faster. It's a mixed bag at all times. We have to get the overwhelming sense, the overall sense we have to get. And even the services PMI or the manufacturing PMI, they are still at highly elevated levels. And I think probably the PMI numbers of India globally are the highest among all countries. I think 56.5 in manufacturing and about 57 point something in services. They are the highest in the world. They're still quite elevated. They're still very much in the expansion zone. So therefore, there is, I think we should not, based on just one number, we should not overlook so many other positives in so many other aspects of the overall economic activity, the overall economy.
Thank you, sir. And sir, with your permission, last two questions.
Yeah.
Thank you, sir. So I'll request Ms. C. Prarthana from Akashvani to ask her question. Not come? Okay, Mr. Laltendu Mishra, if you'd like to ask a question.
Good afternoon, Governor. What is the additional risk we are expecting from the geopolitical tension that is escalating in the Middle East? And what are the safeguards we are having? Thank you so much.
We have cited geopolitical risk as one factor that is in our balance of risks. But as Governor mentioned, our own growth and inflation dynamics are quite robust. And we have also been building up buffers against spillovers from the rest of the world. So we are, I think we are more confident about the evolving situation for India than we were a few months ago.
Thank you, sir. Finally, we'll have Mr. K. Ramkumar from Hindu Business Line.
Thank you, sir. Sir, you in your statement you had dwelt at length on this FIT framework actually. Okay, so just wanted to understand why did you spend so much time on that particular statement? Is there any kind of review you are considering for that band also, a tolerance band for inflation? Anything up this actually? Yeah.
You see, I started by saying that the MPC framework, FIT framework has completed 8 years. Two monetary policy committees in the sense that with different external members. Already that is over. Now we have a third set of external members of the MPC. MPC has completed 8 years, and today's meeting was the 51st meeting of the MPC since its inception. So this is a moment to introspect and to see how the framework has worked. And I said that the framework has worked very well at during the periods of the multiple shocks that we witnessed, and even it has worked well during different interest rate cycles, and it has proved its strength, it has proved its mettle, and it should not be linked to any review or anything of that kind. It was just a moment to introspect, look back and assess how the system has worked, and the system has worked, I think, very well. And we have been able to respond to multiple challenges. I think I would say that we have responded reasonably well. I am qualifying my statement. It has worked reasonably well, and it gives a satisfaction to us.
Sir, one final question, please. Ms. Pallavi Nahata from NDTV Profit. Pallavi Nahata from NDTV Profit.
Yeah, please.
Yeah, sir. Thank you for the opportunity. So, you did talk about how it's a mixed bag in terms of high frequency indicators. There's a chance that the current deacceleration we're seeing in some of them could possibly be seasonal. But given that you've also highlighted some of the upside risks to inflation, are we then also looking at maybe one possible scenario where, higher interest rates could possibly impinge on growth going forward, given that we have fairly ambitious growth rates projected for Q3 and Q4?
At the moment, we don't see any evidence of higher interest rates impinging on growth. Growth continues to be very robust. Investment intentions are quite visible. And at the moment, we don't have any evidence to say that it is impinging on growth. And these high rates have been there now for 2 years, more than 2 years. In fact, I think in 2022 February was the last hike when it was 23 February, 22 we started the rate hike cycle. 23 February was the last hike, because from April it was a pause. So right from February last year, it's already 1.5 years. The growth is holding firm, holding steady. So it won't be correct at this point of time to say that growth is impinging on the interest rates are impinging on growth. I think economic activity is well sustained.
Thank you so very much, sir. With this, we come to the close of this press conference. I thank the top management of the Reserve Bank for taking the questions. I would request the media friends to take the door at the back on that side and to come outside.
Clearly brushing off any concerns with regard to that 7.2% growth projection. So clearly that is a likely positive that he doesn't see, or rather the governor does not see higher interest rates impinging on growth. But Outside of that, plenty of takeaways. First off, inflation is on a declining path, but some distance yet to cover, so some kind of balanced approach required is what the governor is suggesting, balanced approach between inflation and growth. And external sector remains quite robust. Forex reserves is scaling new peaks as we speak. Financial sector remains resilient. Of course, they've highlighted some concerns, but nonetheless, RBI will remain nimble, says the governor, flexible in liquidity management operations. That's one thing which I believe financials are looking out for in any case. Today's monetary policy action gives flexibility and optionality to the MPC. It definitely does. Acutely aware that there is no room for complacency whatsoever. He's reiterated that a couple of times. Depending on overall inflation, growth outlook, MPC will decide on the policy repo rate. He's also suggesting that the lending rate, deposit rate will move in tandem with policy rate decided by the MPC. How quickly will it percolate down to deposit rates if at all a rate cut were to come? Well, non-committal on that one, and also suggesting that there's no real visibility of that yet. MPC takes into account several factors when determining policy direction. Of course, he's mentioned that plenty of times over the last year and a half as well, and rate determination is based on commercial decisions by lenders, and therefore deposit rates, not sure if those will get impacted. But we've got plenty happening in markets as the governor caps off the day, especially with regard to how the MPC views the current economy. And he's announced no change to the repo during the MPC conference. Speculation grows about whether rate cuts are being set up for December. We spoke to a host of experts on what they make of the policy decision. Listen in to pieces of that.
As far as stance is concerned, they have already started infusing liquidity, and with the surplus liquidity, they had to change the stance. In terms of rate cut, they would like to see the actual figures. So that's where, right now, because of the base effect, the projection of inflation has not been changed at all. Even the growth, GDP growth projection has not been changed at all. So by December, I think both of that could be lower, and that's where we have the scope for change in rate. Because as of right now, though inflation is under control and real rates are higher, but GDP is not the GDP is not suffering, the growth is not suffering, and that's why you could keep higher real rates of 2%. But that has to change, and maybe hopefully they will do that in December.
I think as a banker, first of all, I am actually quite happy that we saw a change in stance prior to the actual rate cuts, because this is, by the way, the first, let's say, change in rate cycle that is expected when the banking sector has a significant amount of loans which are linked to external benchmarks and mostly repo. So from a purely banking standpoint, we would prefer liquidity to be easy for a while, where bulk rates come down, retail deposit rates start inching down before we have a rate cut cycle. So to that extent, I think it is good. I think the answer to your question on why rates, by the governor being cautious on rates, I think Jayesh mentioned that. I think we still seem to have a very, very robust growth environment. In terms of GDP growth, actually has been, I think, upped in terms of estimates for the next 12 months. And we have a nice confluence of fairly stable macroeconomic policy, macroeconomic factors, current account deficit largely in control, fiscal deficit again path to consolidation. So I think in a way India is standing out in that sense. And I think given the let's say the geopolitical situation, I guess it is okay to be a little cautious on the cutting of rates front.
What we saw from the RBI today was really broadly as expected. I think it was a really good move in the extremely volatile geopolitical backdrop that we've got at the moment to provide as much forward guidance as they possibly can, right? And so the fact that they shifted to neutral, as they were widely expected to do, really does then set up expectations appropriately for a cut to come, most likely in December. And I think one thing that I was a little bit surprised about was, I guess, the RBI's quite optimistic view on inflation. They've said that, core inflation has bottomed, headline inflation is hovering just below that 4% midpoint target, which is a positive thing. But I think we also need to keep in mind there are those upside risks to food inflation, given weather impacts, but also, and perhaps even more importantly, given what we've seen in the past week or so in terms of that escalation of violence in the Middle East and what that's done to oil prices, we need to really remember that India's inflation, near-term environment is highly vulnerable to changes in global oil prices. And so I think keeping that stance in terms of rates being on a hold does kind of give them a bit more breathing space to keep inflation expectations more anchored, given the upside risk to oil prices at this stage.
Okay, let's also zoom into some stocks which are in focus on the back of all that's happening. Let's pull up some NBFC names, because that's the one big piece or portion of commentary which has been left open-ended for interpretation. The RBI governor himself suggesting that it's not any specific set of NBFCs, but just trying to caution the overall system that certain processes need improvement. There you go. At the moment, no real reaction that you're seeing. Bajaj Finance up 2%. You're seeing Jio Finance also largely flat. You're seeing Chola Investments up roughly 3% Shriram Finance doing fairly well in trade as well. 3+%. Oh, okay, 2+%. Some of those gains have cooled off. You're also seeing good traction in SBI Cards, which has really struggled in terms of asset quality, but nonetheless doing well, 1.6% higher. Max Financial as well doing well, of course, on the insurance side of things. But nonetheless, M&M Finance, if we can pull that one up as well. No real reaction per se, evidently, at least on those statements made by the governor. But that's one sector that we'll really have to focus in on. Let's also look at the realty pack, because some of those stocks really flying away. Of course, on the back of updates as well, their quarterly updates came through. But nonetheless, something like a DLF is up 1.5%, Macrotech up 3.5%. Oberoi also, you can see good traction. Prestige doing well as well in trade, 2.5% higher on Prestige. So you're seeing good traction across the board. Phoenix Mills, of course, coming out with their update as well, and therefore understandably doing well. Ajmera, we spoke with earlier today, 5.5% higher. Looking at a potential 10 to 15% outperformance to their guidance. Ajmera Realty, at least that was what Dhaval Ajmera told us. So therefore, all of those stocks also in focus. Interest rate sensitives, of course. NBFC is likely to gain because as interest rates come off, likely will assist and aid their margins. But realty stocks, of course, the second rung of stocks which will get impacted, second order impact on some of those likely to happen. But let's switch focus. Hyundai IPO, Hyundai Motor. We have Puneet here breaking down all of the details. Price band has been fixed. It's India's largest IPO. Company looking to raise 27,000 crore rupees. Puneet joins us with all of the key details. Puneet, take it away.
Well, thanks for that. So, for Hyundai, we have seen that, they have announced their price band of roughly around 1,800 to 1,960 odd rupees in this particular issue. Now, they're looking to raise, and they are offering roughly around 14.2 crore shares in this particular IPO. So, when you look at, the total raise, the market cap indicator from these two metrics will be around 1.58 lakh crores. And that's the number that we're going for, the total market cap of the company post-listing. The issue opens on the 15th of October till the 17th. And also, the shares will be, you can apply for the shares in the multiples of 7 once after that. So, currently, the anchor portion apart from this will be around 4.24 crore shares. And that will be roughly about 8,300 odd crores. So, a big portion of the anchor book will have to be, subscribed by the mutual funds as well as other Chennai investors. When you look at the split, retail investors will get about 35% share, from the total IPO that they'll be able to apply for, while NIIs will get around 15%, and as we mentioned, QIBs, which anchor investors are part of, will get 50% of the book of the share. Now, when you look at the sales growth of the company, it's been very impressive over the last few years. It has grown from roughly about 7.2 lakh units in FY23 to 7.7 lakh units, while its Q1 performance has also been strong, led by the export growth in this particular time frame as well. Now, when you look at the financials, that's one of the key things to watch out for, because their margins are something which is to watch out for. It's roughly about 13.5% reported in the first quarter of FY25. And that's part of the RHP that we have seen across. Now, when you compare it with the last year, it was around 12%, and that is also higher when you compare it with someone like a Maruti Suzuki, which is its top competitor in the space that it operates in. When you do a more comparison between Maruti as well as someone like a Hyundai, we will see that while Maruti sells 3 times more volumes of cars and has doubled the revenue, as we highlighted, the margins for Hyundai is higher. Currently, for FY24, if we look at the numbers, EBITDA was roughly about 13.1% for Hyundai versus 11.6% that for Maruti. So definitely there. But Maruti also has higher profitability. So profit after tax for Maruti, the PAT margin comes in at roughly about 9.8%. And there are 3 key reasons that we want to highlight. Depreciation is higher for Hyundai. Other income component compared to Maruti is also lower, while the tax to PBT ratio that we've compared is also higher for Hyundai. So those 3 work in favor for Maruti, and that's why the PAT margins are higher by about 110 to 120 basis points when we compare it to Hyundai. Finally, what does that look for valuations? Well, the net worth, we mentioned that it was lower because Hyundai had a very big dividend payout of 15,000 crores odd in FY24, and that's lower the net worth to 12,000 odd crores versus 83,000 that of Maruti. But when you look at the ROE picture, that's also slightly affected for Hyundai because of this big dividend payout. But for the 9 months of FY24, it was around 22% versus 15.7% for someone like a Maruti. Market cap to PAT ratio is also favorable for someone like a Hyundai, and price to earnings is bang in line for both these competitors at 26 times for both of them. So there was expectation of a premium that Hyundai might charge, but it's coming bang in line with Maruti on the price to earning basis, and it's going to be a very interesting IPO to watch out for. Back to you.
Very interesting IPO to watch out for. Puneet, stay with us. More perspective. You've done a bit of a SWOT analysis. Take us through that. And also, if I can ask you post that for some perspective with regard to how grey market premium suggests that likely it's going to be a soft one.
Yeah, definitely. So because of the size of the IPO, it might be that the grey market premium might be a little lower currently, but as the issue comes closer, roughly around 15th of October is when the issue opens, I think this number will be something to keep watch out for as well. When you also look at the strength, as you mentioned, the SWOT analysis of the companies that we did. Now the company has a lot of strengths. Of course, we mentioned it's the number 2 player in terms of market share, currently at 14.6%, and has maintained that despite strong competition of someone like a Tata Motors as well as Mahindra & Mahindra over the last 2 years. When you look at the company's other key strengths also to watch out for has been that it is now generating higher profits as well. So for FY24, the profitability was about 6,000 odd crores, and the margins are also something to watch out for, roughly about 13%, and we mentioned that it's higher than something like a Maruti. But when you look at the weakness of the company, that's been one of the strengths as well, because that's the SUV portfolio. Now Creta has been doing very well. It's about 30% of its sales, but apart from that, they don't have any other product portfolio in that price range of about 10 lakhs, and that's been one of the key things. They have 2 other models in the compact SUV space, but specifically for the above 10 lakh space, it is getting some competition from Tata Motors as well as Mahindra & Mahindra, and it needs to add more in that part. When you look at the opportunities, the EV landscape is one of the key things to watch out for. Right now, it operates 2 models, the Kona as well as the Ioniq in the premium EV space. And but those are very premium, so they will need a mass market product, and that's where someone like a Tata Motors is key, because it has 70% market share. So on that part, it will have to launch more EV models, and it is expected to do so in FY25. And finally, the threats that we look at, it's one thing to watch out for as well, because it is maintaining its number 2 market share, but it's not grown over the last 2 years. While for Tata Motors, it's grown by about 2% and Mahindra & Mahindra specifically has grown by 3% of its market share now to 11%. So one of the key things, of course, is the threat to number 2 position, but it's competing well on the financial part with Maruti. Back to you.
All right. So plenty to look forward to, plenty to break down, and we'll continue to do that on NDTV Profit. But it's all the time we have on this edition of the show. We will be speaking to the Hyundai management in just a while. Do catch that conversation. It's going to be an interesting one on NDTV Profit as well as on our social media platforms. This will happen at 1:35 p.m. So stay tuned for that exclusive chat. But out of time on this one. Thanks so much for tuning in from all of us here. Stay tuned to NDTV Profit. We'll keep you updated on all the action. So stay tuned.
NDTV World Summit 2024, October 21st and 22nd, only on NDTV Network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
simplifying futures and options trading.
Don't worry about the future, as we've got your options covered. Futures and options strategy that will help you move with the tide.
an unmissable trade.
If you want to be in the money.
NDTV World Summit 2024, October 21st and 22nd, only on NDTV Network.
When the whole day passes like a blur,
Hi, thanks so much for joining in. You're watching NDTV Profit. My name is Alex Matthew, and this is the coverage of the RBI monetary policy. Now, we've seen all of the key highlights over the course of the last couple of hours. In fact, just a short while back, you had the culmination of the press conference that was hosted by the Reserve Bank of India to talk about the decision that was made. And in case you missed it, that decision was a 5:1 vote by the Monetary Policy Committee to hold the rates unchanged, and perhaps more importantly from the perspective of future course of monetary policy, a unanimous vote by the 6 members of the Monetary Policy Committee to change the stance to neutral from withdrawal of accommodation. Just a short while back, you had the Reserve Bank of India governor say that everything that was meant to be achieved in the withdrawal of accommodation has been achieved, and that is why the stance was changed to neutral. Now, there's more to talk about, including the projection on growth as well as the projection on inflation, which has remained unchanged for the full financial year. But to talk about the key highlights and the key takeaways from the rate decision, from the monetary policy decision of the committee, I'm joined by my colleague Pallavi Nahata. Pallavi, what stood out to you?
Hi
Alex, so like you've mentioned, of course, while the benchmark lending rate was retained at 6.5%, we did see a change in stance to neutral. And what stood out, in fact, in the recently concluded presser was the RBI governor and deputy governors emphasizing that the change in stance needs to be looked at independently. And what that possibly meant was, given the entire, given that the governor did continue to emphasize that they're continuing to very closely monitor inflation. It continues to remain a data-dependent approach that the RBI continues to take. We're going to be watching out for a whole host of factors, how they evolve, especially the upside risks to inflation that the governor highlighted multiple times during his speech earlier and during the course of the press conference as well. But of course, apart from what was said about the change in stance, the rationale behind it, and how it needs to be viewed independently, what also stood out, like you mentioned, was the fact that CPI inflation forecast for the full year was retained, and as was the GDP growth forecast. That was something that definitely stood out, because a lot of us had been expecting possibly a small cut in the GDP growth forecast, given where we've seen Q1 numbers come at, given we have seen some easing in high frequency data post that as well. But in fact, in response to a question by NDTV Profit, the governor actually did say that economic activity continues to remain resilient. They do not think that the current lending rate is actually impinging on growth or is likely to do so going forward. That was also one of the key takeaways from the presser. So let's have a quick look at what the forecasts were. For CPI, we continue to look at, Q2 at 4.1%, Q3 at 4.8%, and Q4 at 4.2%, with risks evenly balanced. I think one of the last key takeaways was, of course, the message that the governor sent out to Nbfcs.
Right.
And during the course of the presser as well, they did say that while it was not directed specifically, broadly at an industry level, while there is no reason for concern, that is something they want, players in the industry to sort of course correct on by themselves going forward.
Absolutely.
Just the pace of growth and what's sustainable.
Yeah, absolutely. In fact, we're going to talk about that with our guests today as well. Pallavi, we're joined by Abik Barua, who is a Chief Economist and Executive Vice President at HDFC Bank, as well as Anubhuti Sahai, who is the Head South Asia Economics Research at Standard Chartered Bank. Thank you so much to the both of you for taking the time this afternoon. I'm curious about what you have to say about the change in stance, because as I saw the expectations today, 10 out of 13 economists that have been polled had expected the rates to remain unchanged. Were you anticipating a change in the stance, and what did you make of the comments that were made by the central bank governor as well as his...
Sorry.
Please go ahead.
I certainly was anticipating a change in stance, and I wouldn't necessarily see it as independent of future rate action. I think what the change in stance does is kind of build the base for a possible rate cut going forward. If you still had withdrawal of accommodation, it would be a little more difficult to actually cut rates. So maybe they are building towards it. Pallavi gave a very succinct summary of what the message was. And indeed, there are a number of risks on the horizon, particularly coming from things like fuel prices, metal prices, because we still don't know how the Middle East and even China will play out, because there was temporary euphoria about China, which sort of pushed up metal prices a little. Oil, we know, is very, very uncertain. There is a little bit of a question mark on food. That said, if things do remain kind of well behaved, and I think this opens up the room for a rate cut going forward. I wouldn't I stick my neck out and say that if things actually behave well, then December might be the first time they cut rates, but I wouldn't really bet on it. But one thing I just wanted to point out, if you allow me, is that, I mean, there was a lot of discussion around the fact that the Fed has cut rates and the RBI will follow, and there is a sort of synchronization across central banks, etc. I think the RBI's line has been that the domestic conditions are central to decision making, and external factors have a limited impact. They do, I'm sure, play some kind of a role. But I think we emphasize the centrality of domestic conditions in a rate and monetary policy decisions on the whole.
Yeah, it's an important point that you make. Anubhuti, I'm curious what you make of what was just said by Abhik, and also the point that was made at the end of the press conference, if you heard it. Pallavi herself asked that question. The fact that there is a mixed bag in terms of high frequency indicators, the stance is neutral. There are concerns that some people have raised that economic growth is not as robust as some might think. But the RBI governor seemed quite sanguine about that. Are you?
Well, our growth projection is at 6.9%. This is only slightly different, a little lower than where RBI is projecting it, which is at 7.2%. And I think we agree with the broader narrative that we can see a much better growth environment getting into the second half, primarily driven by a revival in rural demand, plus government capex picking up, etc. But in terms of GDP projections itself, I think if there might be some disappointment at the market level, because markets have got used to growth numbers in the 7 to 8% kind of a range over in FY24 in specific. But in the next 3 to 4 quarters, we'll clearly see a downtick moving the growth projections or growth numbers printing in the range of 6.5 to 7%. To that extent, it can be disappointing, can increase voices around rate cuts, but it will be a far more inclusive growth. And probably we, as economists, we always prefer GVA. And in terms of GVA, our sense is the numbers won't be very different from where we were last year. Now, coming to this policy in specific, I would say that the policy clearly had dovish undertones. I think the change in stance is just one small part of it. But if you look at the way the description around inflation has evolved over the past few quarters, from saying Arjuna's eye to talking about elephant is still needs to reach the forest, to talking about horse and stable. And even if you read the statement, there is a very specific phrase where he says that inflation is now closer to the target. So I think it's a big shift which we have seen over the last couple of meetings and what we heard today. Of course, he has to caveat it. The governor has to caveat it. The MPC has to keep the optionality, whether it is about the global external risks or about India's own food inflation trajectory. But December looks a high probability meeting where we might see a rate cut happening unless something goes wrong externally, or if the deviation from the 5% inflation both in September and October is significantly on the higher side. Unless these two things play out, I think December rate cut looks now pretty likely in our view.
Am I right in assuming both of you and both of you have talked about a December rate cut, but a small one, 25 basis points on the cards? I'm guessing that is the case. Now, I'm curious about what you think about the external factors, because the governor stressed about this several times over the course of the policy statement, as well as in the press conference where he spoke about energy prices globally. He's spoken about geopolitical risks as being a key factor to watch. According to you, is this the fly in the ointment that could change projections completely? Is this something that would change the narrative as well? Crude oil prices estimated at what, $80? Abhik, does that change dramatically if crude oil prices spike?
Absolutely. I don't think it changes the fundamental narrative that we've sort of got inflation more or less under control. But if these risks were to pan out, then there is a problem, and the immediacy of the urgency of rate cuts, given the scenario on growth that Anubhuti painted, that you might see some disappointments at both at the headline level and also at the more granular level, and I kind of agree with that, even with some sort of more informal data that we are picking up as a bank. Now, if you if things go completely haywire, particularly on the geopolitical side, and don't forget that U.S. elections are also around the corner. We really don't know how that will play out in terms of expectations. If there are high tariff expectations, for instance, then you are looking at a potentially inflationary scenario. So I think there are a lot of known unknowns, and if things go a little awry, December might not be the time to cut, and it's going to be very data dependent. It's going to be very event dependent. But I think the underlying sort of languaging and the description or narrative will be in place, and this will be seen as kind of temporary deviations. I don't see the narrative fundamentally changing. It'll sort of be a put on hold kind of approach that the RBI will have to use to accommodate or respond to domestic shocks or external shocks.
Okay, point well taken. We do have to cut across just for a very short while to the Hyundai press conference right now. The managing director, Unsu Kim, is speaking about the upcoming launch of the IPO. Do stay tuned. Let's go across to that first.
HMG has established a centralized R&D hub that drive global initiatives with investment surpassing $26 billion since 2014. With our vision of a prosperous humanity, we, HMI, benefit from HMC's extensive global ecosystem, which gives us a strategic and competitive edge against our competitors. HMC's early access to trending technology, supported by profound R&D capabilities, enable us to bring industry-leading features to the market in a short period of time. And our powerful Hyundai Motor brand provides us with exceptional global recognition and lineage that set us apart in the industry. Moreover, HMC's global platform offers doors to lucrative export opportunities, allowing us to expand into global markets and implement best practices to the Indian market. Our productive relationship with HMC is the key driver of our success and drive us to continue growth in the future. I will now hand over the presentation to Tarun.
India is not an easy market to crack, as is seen by very limited success global big automakers have achieved in India. However, Hyundai has successfully built the second largest auto franchise over more than 26 years of operations in India. We are an iconic brand with consistent double-digit market share. We're also the largest exporter on a cumulative basis since the last 2 decades. So we are actually a double-engine growth, domestic as well as exports. We have a large local dealer network with 2,900 plus touch points spanning across the length and breadth of the country.
All right, so that's the management of Hyundai India speaking about their company ahead of the launch of their IPO. That takes place on the 15th and the 17th of October, and based on the price band that has been declared, this would be the largest issue in India's history. Certainly something to watch out for. We were talking about the RBI monetary policy, and there were several points that have already been discussed by Abhi as well as Anubhuti. I'm curious about what Anubhuti has to say about what was discussed beyond the scope of just the RBI monetary policy, because there were statements that were made about regulation in the banking space, in the NBFC space, that potentially posing systemic risk. The RBI stopping short of making any declarations or changes in the regulations, but saying, be cautious. What did you make of that?
Sure. So I think here the messaging is very clear. In fact, we have been seeing a whole host of measures being rolled out by the RBI since late last year, and it's extremely important to keep a check on it. Even though unsecured loan growth has climbed down, it's still at it's still in double digits, and probably that is something which keeps RBI extremely vigilant. imagine a scenario going forward, say next 6 months, not necessarily December itself. If interest rates in India, RBI, if RBI starts easing interest rates, this in turn can undo a lot of a decline in unsecured loans which has happened, and probably can fuel lending in areas which are not that comfortable for the regulators. So I think this also paves the way forward for easing the interest rates for the economy at large, but at the same time rolling out measures, macroprudential measures, to ensure that easy liquidity at easier price does not fuel some kind of vulnerability in the financial sector over a period of time. So I think it's a very good approach, and probably we are likely to see more of these going forward, especially when the easing cycle starts, and in case these areas of concern are not fully addressed by specific entities.
All right, Abhi, Abhi, coming to you, I do want to ask you, while the broad consensus does appear to be that we could see a possible rate cut, presumably of about 25 basis points in December, is the rate cut cycle still expected to be a shallow one? And also, how much of an impact do you think that will help provide to growth impulses, given that we did see a little bit of easing there? Also, what's your projection on GDP growth forecast for this year?
We are a little more, so let me start with your last question. We are a little more conservative, I would say far more conservative on GDP growth. We have a number of 6.8%, which is not significantly different. But I think qualitatively, it sort of indicates that there are pockets of concern, which perhaps the RBI is not highlighting that much. I see private investments as a problem area because, and I'm glad you sort of cut across to the Hyundai IPO, because if you saw some of the numbers, one of the numbers at least, that the Axis Mutual Fund had released just a couple of months back, it showed that for the pipeline of IPOs that we'd seen over the last 14 months, only about 6% was for CapEx. Hyundai is one where clearly there is a lot of CapEx associated with it. But in terms of while there are intentions, financial closures have taken place, credit drawdown for investment purposes have been slow. And I mean, I think that there would be some consensus across banks on this phenomena. So there is, there are some concerns about growth. I really don't know whether this will be a shallow rate. I would presume that this would be a shallow rate cut cycle because, I think with the way the, things are going in terms of the frequency of shocks and the extremely difficult external environment, I think we are moving to a relatively higher inflation scenario on a long-term basis. So I think for central banks in general, rate cuts will have to be will be perhaps shallower, and I think the relationship between growth and rate changes have kind of weakened a little. So you might just sort of get away with relatively good growth, low unemployment, and yet not have to cut much. So that's the sort of neutral rate argument, which is there for the US, which is there for the Indian economy and so forth, that the neutral rate has actually increased. So, that in a nutshell is my point. I think that the RBI, to cut a long story short, the RBI is not recognizing some of the risks. I think the private consumption number in the first quarter GDP was a huge overestimate, which none of the consumer companies would sort of agree with. And I think there is a problem, with private investments, except in a couple of sectors. Whether interest rates cuts will make a difference or not, whether these decisions are influenced by the cost of capital in India or emerging markets like India, is another long story. But I mean, there is a problem. Let me say that I see it as a problem, which is partly reflected in my GDP projection.
Okay. Anubhuti, do you share some of those concerns, especially, for instance, the RBI is, for instance, banking on some sort of a recovery taking place in the rural sector. We're already, of course, seeing some signs of that, that along with the, excess rainfall that we've seen in the southwest monsoons, the expected outcome from agricultural sector, but also the fact that, a lot of sort of corporate earnings, for instance, do seem to belie the extent of the recovery we're talking about. Is that a concern you share, maybe, Anubhuti?
Yeah. Yeah, sure, Pallavi. So as before you joined, we did discuss this. So our growth projections are at 6.9%, and I think the narrative with which we agree, with what the governor highlighted is that we do see a revival in rural demand driven by a good monsoon, but it will take time to show up in the GDP numbers. Private investment will still take time to come back in a significant manner, especially in the current global environment where there are a lot of uncertainties around geopolitical tension, presidential election results in the US, and government capex will has started picking up, but of course there is a limit to which it can push growth higher. So to that extent, the GDP numbers to the market at large might disappoint. The market had got used to a GDP number in the range of 7 to 8%, very broadly put. We are, over the next few quarters, headed towards a GDP range of 6.5 to 7%. And that will come as a disappointment. Though, as economists, when we look at GVA, that disappointment will not be that strong. Of course, there are a few areas of concern, like private investment, etc., etc. Those concerns have been there for quite some time. But overall GDP, story in our view is likely to become far more inclusive, and I would say that I'll be far more happier with a 6.9% GDP growth number rather than an 8.2%, which was so non-inclusive.
That's a very fair point, and an interesting one that you make at the end of this conversation that we're having with you. Thank you so much to the both of you, Abik as well as Anubhuti, for joining us this afternoon and giving us your perspective. Pallavi, insightful chat. I'm curious about what you have to say about the RBI governor and some of the analogies that he has used over the course of the last few monetary policies. I'm sure that our viewers have some recollection of some of this, where they've heard the RBI governor talk about the elephant that has been in the forest and that has refused to move away. And there he's talking about inflation. He's changed his analogy today to talk about horses. And somebody asked him on the press conference why he's using horses and elephants, and here's what he had to say.
It's not a shift. The reason for earlier I used elephant, this time I'm using horse. The reason is that it's a war against inflation. And in a war, elephants and horses are used historically. Arjuna will come when there is a requirement. Arjuna, with his Brahmastra or with Narayanastra or the various astras that Arjuna has, will come back if and when necessary.
All right, if and when necessary. And quite an interesting analogy that has been provided by the Reserve Bank of India, and that kind of helps you understand monetary policy in a better way as well. The RBI and the Monetary Policy Committee, of course, as you know, targets inflation. And so the analogy of Arjuna is quite appropriate here. Let's talk about the expectation of rate cuts going forward, because that really is what the street is focused on. The stance shift to neutral is something that was seen as positive by the street, and the equity markets are trading higher on account of that. But we asked a host of experts what they make of the policy decision and the timeline of future rate cuts. Here's what they said.
As far as stance is concerned, they already started infusing liquidity, and with the surplus liquidity, they had to change the stance. In terms of rate cut, they would like to see the actual figures. So that's where, right now, because of the base effect, the projection of inflation has not been changed at all. Even the GDP growth projection has not been changed at all. So by December, I think both of that could be lower, and that's where we have the scope for change in rate. Because as of right now, though inflation is under control and real rates are higher, but GDP is not the GDP is not suffering, the growth is not suffering, and that's why you could keep higher real rates of 2%. But that has to change, and maybe hopefully they will do that in December.
All right, December is when we're expecting to see a rate cut. Let's see if that pans out. In the meanwhile, let me take you through what's happening in the equity markets right now. We've seen that the Nifty 50 has given up ground in the last 15 to 20 minutes or thereabouts, and you're seeing a drop of about 150 points from the high point of the day. Nifty 50 now trading with gains of just about 0.33%, but holding above 25,000. That is going to be seen as at least a sentimental level to hold on to. The broader market's still looking buoyant, though. You have the mid-cap index that's gaining about 1.2% or thereabouts, and you have the small-cap index that's up about 1.4% or so. The Nifty Bank has given up all of its gains. At one point, it was up as much as 0.8%, but now it is dropped all the way to flat territory, and if at all, it might actually break into the red. This is where you're seeing a large amount of selling coming through, and this is where you've seen a large amount of selling in the recent past as well. In fact, let's bring in the components of the Nifty Bank just to give you a sense of where things stand right now. I would hazard a guess to say that the frontline banks are seeing selling, and there you go. You have HDFC Bank that is losing about 1% and contributing to quite a bit of the declines, but you have SBI that is up about 2% and holding out. PNB as well gaining ground right now. But that's all the time we have for you on this edition or this particular show, but there's lots lined up over the course of the day. Do stay tuned. This is NDTV Profit.
NDTV World Summit 2024, October 21st and 22nd, only on NDTV Network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
Oh, it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying futures and options trading.
Don't worry about the future,
as we've got your options covered.
futures and options strategy that will help you move with the tide.
An unmissable trade.
If you want to be in the money.
NDTV World Summit 2024, October 21st and 22nd, only on NDTV Network.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the
Hello and welcome to NDTV Profit. I am Agam Vakil and you are watching the IPO special. Well, we have Hyundai where the IPO opened for subscription today, and it's going to be a really interesting one because it's one of the largest IPOs that we've had for the year and for a while as well. But I'm going to say no more and, well, get my colleague Puneet in to fill us in on all the details that we need to know about Hyundai. Puneet, over to you.
Well, thanks for that. So, it's going to be, as you rightly said, one of the biggest IPOs. Roughly 27,000 crores is what the company is looking to raise from this particular IPO. Now, that said, the company has announced a price band of about 1,865 to 1,960 odd rupees per share. Now, that indicates, that the market, that you can bid for about 7 shares in one particular allotment. And the total shares will be, the IPO opens between October 15th and 17th, while, they're willing to offer roughly about 14 crore shares in this particular IPO, and it's a completely offer for sale. No fresh issue in this particular IPO. Now, when you look at, the key numbers, based on the number of shares that the company is offering, which is 14 crore, as well as the highest price band of 1960, the indicative market cap of the company could be around 1.58 lakh crores. And the anchor portion of this will be around 4.24 crore shares. So the anchor book is going to be around 8,000 odd crores, which is a sizable number because it's going to be one of the biggest IPOs as well. But currently, 35% will be allocated for the retail book, while 50% will be for QIB and 15% for the NII ownership as well. I just want to quickly highlight a few numbers specifically for Hyundai. We've seen a strong sales growth for the company over the last couple of years, and that's reflected in the growth as well. For 7.77 lakh units it's sold, up about 5 to 6% from the last year levels. But